very much for teaming up with us to host this event. I can guarantee I was not part of arranging for the tube strike, so we tried to do our best. But it is my pleasure and honor to introduce and invite to the podium our keynote speaker today, John Glen, who is the Economic Secretary and the City Minister of the Treasury of the UK government. He is known to be the longest-serving economic secretary in the organisation. I don't think he needs a lot of introduction of biographical details here. We all know his expertise, his respect, and his approachability towards the industry, towards the wholesale market participants. In his capacity as City Minister, he embarked on an extremely ambitious agenda of reviewing and overhauling the entire financial regulatory system, the entire legal framework regulating UK financial markets. And a major component of this is the wholesale market review, which of course is the key topic for our discussions today. He has been, and his team has been, extremely open with the consultation, with engagement, and all sorts of forms of conversation with the industry to try to find the best balance of different policy objectives in order to retain the leading role London and the United Kingdom plays in wholesale markets globally and also in Europe. His commitment to furthering this agenda could not be better proven than by the fact that today he made it all the way walking from Whitehall to this conference to make sure that he can join this event without sufficient public transport services. So, John, we are very grateful for your effort and commitment, and I would like to invite you to make your introductory remarks before we have a small chat, and we look forward to hearing your comments.
Thank you, Adam. Thank you, Adam. Great. Well, it's a great pleasure to finally be here. And when Tom was trying to hail the taxi, after the first 15 minutes, I said, forget it. We're going to get there on time and we'll start walking. So we did. But good afternoon, everyone. And thank you to AFME for inviting me to speak today, and to Linklaters, of course, for hosting us. I wish this speech was being made under happier circumstances. Like all of you, I'm appalled at the scenes of conflict and bloodshed that have unfolded in Ukraine. And clearly the Russian invasion is an unwarranted and unprovoked attack on a sovereign nation. It is an assault on the principles of freedom, democracy and peace that have served Europe so well and for so long. And that's why we as a government stand resolutely behind Ukraine and its people. And it's also why we have already announced the most stringent sanctions in history on Russia, a set of measures that will have a severe and immediate cost. And we will not hesitate to take further action as it is needed, including by strengthening the Treasury's powers to enforce financial sanctions. This has been an incredibly difficult week for Ukraine and the whole global community. But I think it's also a moment to reflect on the UK's place in the world. Because as the Chancellor said last week, in future our global influence, and therefore our ability to be a force for good, is going to be in part based on our economic health. And as the City Minister, I believe that our financial services industry is going to continue to be key to building that economic strength. And as a result, the government is using our post-EU freedoms to create the right legislation to support an even stronger financial services sector. One that is open, green, competitive, and technologically advanced, as the Chancellor set out in his Mansion House speech on the 1st of July last year. And we've already set out plans to create a financial services regulatory framework that is agile, fit for the future, and supports high standards. and our plans to improve our wholesale markets regulation, the subject which I'm going to speak today, is central to this reforming agenda. Now, I'm quite sure that over the past few years, lawyers in this very building have burnt vast quantities of midnight oil, poring over the intricacies of MiFID, the EU framework that governs wholesale markets. Undoubtedly, the framework, which I acknowledge the UK helped to develop, has some positive aspects, not least in the way it has bolstered the resilience and effectiveness of our capital markets after the global financial crisis. But over time, it's become clear that there is real scope to improve and update MiFID and tailor it to the UK's deep and global capital markets. Some rules have left firms facing onerous administrative burdens. Others have failed to stand the test of time and do not operate as intended. And now that we've left the institutional frameworks of the EU, there's no reason for this to be the case. And as a government, we recognise there's a real need to act. First, because wholesale markets are integral drivers of our domestic economy, but also because of our market's international preeminence. More derivatives are traded in London than anywhere globally. We're also the world's largest centre for foreign exchange trading. And this conference, with its representatives from many European and international firms, is in itself clear evidence of the vibrancy and variety of our markets. So through our reforms to the MiFID framework, we intend to deliver rules that are fair and outcomes-based, rules that support the openness and competitiveness of this country, and that increase businesses' access to finance so they can continue to boost the wider economy. But we're, of course, very aware of the time, money, and effort that you've collectively invested in adapting and adhering to MiFID over the years. So this was never going to be, and it isn't, about change for change's sake. And I should stress that we are still very much signed up to the overall objectives of the MiFID regime. In addition, as we all know, regulatory regimes are not static, and the UK and the EU's regimes will evolve as both jurisdictions adapt their regulatory frameworks to their markets' needs. So while our new freedoms mean we can now move faster than the EU, that doesn't mean that we won't stop watching our European neighbours approach closely, and we will remain very open to ongoing cooperation with them. And it's in that spirit that I'll be visiting Brussels later this month, where I'm planning on discussing wholesale markets reform and talking about some of the other regulatory changes for primary markets that I will also address a little later. But we've already taken some important steps as part of our reforming agenda. In November, I announced that we would legislate as soon as possible in a number of areas. In particular, I said we would abolish the share trading obligation, a cumbersome requirement that only exists in the UK and the EU. It effectively bars our firms from trading in the places where they could get the best prices for their investors. I also said that we would amend the scope of the transparency regime for fixed income and derivatives markets. This will ensure our regulation is more effective and less burdensome, so that it truly reflects the differences between financial instruments. In addition, I announced that we would scrap the double volume cap. As with other elements of MiFID, there is simply no evidence to support it. In fact, no jurisdiction on the planet other than the EU has such a requirement. And we believe that removing the cap will give investors more choice and cut transaction costs. Now, I'm very aware that some critical voices say that these changes will result in a more opaque market, with trading not properly reported or scrutinised. I strongly disagree. Clearly, transparency is integral to financial markets, but to be effective, rules must achieve their aims. Many of them currently do not. The changes I've outlined will improve transparency and therefore the way the market functions by ensuring the right information is made public. Today, I'm very pleased that we've taken another big step on our reforming agenda, following our Wholesale Markets Review consultation. I can announce a series of further measures which we intend to bring forward as a priority. In essence, these are common sense, yet significant changes. They will liberate businesses from unwieldy and stifling rules that hold back their ability to grow and innovate. And they will make this country an even more attractive destination for firms that want to access capital. First, we are going to cut burdens on systematic internalizers, a group of businesses that play a critical role in the wholesale market system. For example, under MiFID, SIs must undertake regular and complex calculations simply to prove their status. Now, this might have been necessary to ensure that 28 regulators achieve the same outcomes, but we really don't need to hard-code regulatory decisions in law like this. I'm pleased, therefore, that we can return these judgments to the FCA, as was the case pre-MiFID. Furthermore, we will remove restrictions on how SIs can trade so that they can execute orders at the midpoint between the best offer and best bid. This is common practice in other global markets and will result in better prices for investors. Second, we're amending the scope of the derivatives trading obligation. This change will provide greater clarity to businesses, helping firms to manage risk. We will also give the FCA a permanent power to modify the DTO's scope to improve market resilience and prevent fragmentation. Third, to improve the quality and boost the user-friendliness of market data for investors, we're going to give the FCA the tools it needs to help the industry develop a consolidated tape. This will combine market data from multiple areas into one place, giving investors a clear source of information while cutting costs and complexity for firms. And finally, we will still further delegate the non-equity from the pre-trade equity transparency regimes to the FCA for it to reform. This is because we believe that while it's right that government sets priorities, our expert and respected regulator is best positioned to calibrate the rules. So we think this change will result in more proportionate and effective regulation. I should point out that this measure is in line with the longer-term proposals that we've set out as part of our future regulatory framework review, to give our regulators greater agility to tailor rules as they evolve. However, the fact that we're making this change now underlines the importance we place on getting this area of regulation right. This isn't going to be the only wholesale market review reform that our regulators will be taking forward. And I'm sure that Edwin Schooling Latter will update you later on the detail of the continued collaboration between the FCA and the Treasury on these issues. I should also point out that where there is evidence that further MiFID reforms would improve our market's agility and competitiveness, we will consider how best to take forward any such changes. But beyond the FRF and the Wholesale Markets Review, we want to keep working with you on a broader range of priorities and challenges. Our work to deliver our ambitious regulatory reform agenda for primary markets is among them. There is, of course, much to celebrate here already. Last year, over 120 companies went public in the UK, raising £17 billion, the most in any year since 2007. Nonetheless, I'm very clear that there is more to do to attract the best businesses to the UK. And that's why the FCA, we've been working on delivering the recommendations with the FCA on Lord Hill's recent listings review. And over the past months, the FCA have made rapid progress in a range of areas, giving founders and business leaders, particularly those in the tech sector, the flexibility to raise capital in a way that suits them. While last year, the Treasury undertook a fundamental review of the UK's prospectus regime, which we inherited from the EU. And today, I can confirm that we intend to move forward with our plans to replace the current system with a new, simpler and more agile regime. I'm very excited about these changes. They will remove unnecessary duplication and red tape for firms that want to raise capital. They will modernise regulation covering this area, and they will benefit investors, ensuring they receive the best possible information while creating new opportunities for retail investors to participate in public company ownership. In addition, businesses will enjoy a more liquid and supportive market, giving them better access to the finance they need to grow. And firms will be able to more easily obtain alternative forms of finance through our plans to support equity crowdfunding. That's not all. These improvements will provide an important consumer safeguard by bringing non-transferable securities, the type of mini-bond issued by the failed investment firm London Capital and Finance, into regulation. As you may recall, this was a key recommendation of Elizabeth Gloucester following her investigation into LCF last year. So, reforms for wholesale markets, reforms for primary markets, help for growing businesses and new protections for consumers. And this is far from an exhaustive list of all we're doing to improve financial services regulation. As I've made clear today, boosting the attractiveness of our capital markets is of the highest importance for this government, and we're working very closely with regulators to make all this happen. Naturally, we also recognise the importance of continuing the conversation with AFME and the wider industry about our financial services agenda. So please keep talking to us in the Treasury, and I can promise you that we will keep listening. So thank you very much for your attention, and I look forward to a few questions from Adam now. Thank you. I'm not frightened of you, Adam.
No, I think we are beyond COVID times where we have to
we are beyond COVID, yeah, absolutely.
The two sides. So thank you very much for your remarks. I think you provided a lot of clarity in terms of the overall public policy objectives, also the relative changes vis-à-vis the sort of inherited or onshore EU system. And I would like to start with a question relating to this. We at AFME represent firms who have different headquarters. They have different origins, but what keeps the membership together is that all these firms are operating on both sides of the channel. Yeah. So, of course, for these firms, watching the review, which, as you said, it's a legitimate review of an existing framework, both by the EU as well as the UK government, one of the concerns firms would have is to follow and comply with two very different regulatory systems on the way forward. I think you made some remarks in this respect, but I would like to ask you, what else can you say to reassure them that this is not going to be overly complex or costly?
Well, Adam, I think the key point here is we made a decision to leave the institutional framework of the EU. Therefore, regardless of what people think about that, we are going to be on a separate trajectory. But as I said, well, I think it's important to recognise that doesn't mean we're predisposed or predestined to go down a deregulatory route, or we're trying to differentiate on regulation. I've always said through these 4 years that I've been in this post that we will not establish a competitiveness for the City of London as a whole by deregulating. So yes, there will be differences, but what I've tried to do and what I set out in my speech is reasons and the reasoned arguments for doing it in the way that I said, but the differences are not designed to be, I mean, they're bound to have consequences, but they're designed to be right for the City of London as a deep liquid capital market with the international opportunities that exist. So that principle guides us, but of course there will be differences, and by being clear about the motives behind it, I'm hoping that we can be clear that there'll be no rationale for sort of sort of hostile acts from the point of view of the EU, because we're just trying to do the right thing as they will do the right thing. We have strong bonds of common heritage in these regulations, but we've both got to develop them as we move forward.
Thank you. Thank you very much. And I also noted your remark about your upcoming visit to Brussels, which I think is an excellent development, given that the EU has also embarked on its own review of the wholesale market framework, or MiFID in more general. And I think the questions you raised, the points which you mentioned, are exactly the questions that are being raised in the EU as well. One of the regarding the specific proposals you made, one of the I wouldn't call it allegations, but one of the concerns sometimes you hear when these specific questions about the transparency of the market, about the role of SIs, one can hear is that some of the ideas you set out might lead to a less transparent market. And I think what you stressed is that the powers the FCA is going to have is going to be aimed at ensuring that sufficient level of transparency remains, and market integrity will be safeguarded. Can you elaborate a little bit?
Sure. Look, the first thing I'd say is that I very much value the dialogue with our friends in Europe. I was in Spain just before Christmas. I'm going to Luxembourg tomorrow. I'm going to Brussels in a few weeks, and these dialogues are very important. In terms of deepening understanding of direction of travel and what's going on. But all I say is let's have a rational assessment of what the effects of some of these things have been, even if the intention was good. And we, of course, in the UK played a key role in shaping some of these directives, but they didn't always end up in a place that we were entirely satisfied with. Now, if we're not going to take the opportunity of this freedom to do things in a way that we would see as optimal, then when will we? And there are some who would say, well, you're too slow, you should just strip away MiFID II with the strike of a pen. Well, that's not realistic either, because, as I said, many of you have spent hours working on how to adopt those the implications of those frameworks, and what I've got to do is right-size it through a careful process. But I think about things like double volume caps in terms of what it actually gives us, and when in jurisdictions like the US, where it sort of probably plateaus at 10%, some of those rules were artificial. So when you talk about dark pools, it sounds dodgy, but it isn't in the way it operates. So all I'm just saying is let's have a rational, clear conversation about what behaviours exist, and then let's regulate for that. And where there are issues and concerns around transparency, let's measure them against what's happening in other jurisdictions. But we've got to do the right thing for London and the UK. That's my obligation.
Thank you very much, and I think I think it's not opportunistic to say that we share a lot of these concerns, and AFME members have been arguing for saying that dark pools are not dodgy, and the role of SIs should be seen.
They need to be rebranded. I think that would have helped.
Yes. The next question I wanted to ask is relating to international cooperation in the financial services space. Now that the United Kingdom and the government, also the regulatory agencies, are out of the sort of the EU institutional structure, what is your agenda for international cooperation in financial services in the context of the prudential or the markets framework, or on the disclosure framework relating to the green transition?
Well, Adam, I've always believed it's been a privilege to do this job. It's a privilege to represent an industry that is a global leader here in London. And that means we've got a responsibility to continue to take a leadership role in international fora. I mentioned some of my trips. I'm going to the US as well. There's lots of conversations to deepen through our UK-US regulatory working group relationship opportunities there. We've got a very advanced conversation with the Swiss on an MRA, which will be ambitious, and I hope a real a new benchmark really for how cooperation can work. We have an economic and financial dialogue with India, Brazil. We expect to have one, with a number of countries, and we've now got the flexibility to have, bespoke conversations that suit the dynamics and opportunities that exist on both sides. So that principle of being open to new ways of doing things. Of course, sometimes in free trade agreement conversations across Whitehall, people ask me, what do I want for financial services? And usually there are things that we need to ask for, but it's actually about having a mature dialogue, regulator to regulator, Treasury to Treasury, on an ongoing basis. Financial services is a very dynamic environment. If we think about the implications for blockchain, for FMI and for the whole future of verifying transactions, there are lots of opportunities. There are some risks as well, and we will continue, and the Chancellor will continue to have great ambition in all of these areas, because we have that responsibility as a global centre of finance here in London, and I'm ambitious for that, but also recognise that there will be different concerns from different jurisdictions, but we will be open. We will continue those dialogues. Just this afternoon, I've got more of those from conversations with people from other jurisdictions.
Thank you. And needless to say, AFME members are extremely supportive of this. We have in all public communications, we found a way to express this support, because we feel that for a globally interconnected financial services market, this is going to be key, not only with respect to the EU, but for the rest of the world as well. So thank you for that. One other question I would ask is, you mentioned another element of the regulatory review agenda, which is the listings review. Again, something that is being reviewed in the EU, but also in other jurisdictions. In your view, what will be the key measures or the key attractions that could be, or the key questions that would need to be addressed in the context of that review, which would be the game changers or the key levers in improving the competitiveness of London to attract listings in this market?
Well, I think Jonathan Hill did an excellent job with his review, and we've taken on many of those recommendations. I've mentioned, the things like the dual class shares, the different free float level have been very important. I think, though, the prospectus regime changes are really important, because we want to make it easier for firms to say, well, actually, we can have confidence in the journey through to initial listing. We're not going to have to put so much at stake, if you like, early on. But then we've also got an opportunity subsequently to raise capital more straightforwardly. And one of the things that Jonathan said that we should do is look at capital raising. So we've got people looking at that as well. And I'm looking forward to progressing some of that work. But I think it's about saying, how can we remove information flows and barriers that are not adding value, and think about it more from the entrepreneur's perspective about how we can optimize that, how we can create assurance around access to pools of capital and assurance over that journey forward. So we look at it in all dimensions, and I've got Mark Austin doing some work for us, which we're very grateful for, looking at how we can make it easier for listed firms to do capital raising as well, looking at other jurisdictions, perhaps Australia, in terms of where there are lessons to be learned. So I think the prospectus reforms and many of the elements that Jonathan set out, which have got more things to look at.
Thank you. Last question, if you allow me, but not least, and it's not an easy one. It is relating to market access, which again, in the time of crisis, it always comes up. In Europe, there is a lot of discussions about market access and strategic autonomy. In the UK context, which has always taken a very open position and welcoming market access and being a global financial center, one part of the legal framework, which is the basis for market access, is the overseas persons review, overseas persons exemption system, which is also under review. Can you share some thoughts about that? What is the direction the UK is going to take in that space?
Yeah, I mean, this is a very important hallmark of our approach in London, which is to be open, to have people to be able to work here from lots of different jurisdictions. But we've also got to get that balance right between adherence to our rules and frameworks here. So we are continuing to look with a constructive mind at the rules that we have at the moment, but what the implications are of that openness and getting that calibration right. So we will look at that in the course of the next few months. I don't have a precise date where we will announce something on that, but it's an important component of our narrative, being open, wanting to strive for competitiveness, embracing the green agenda and embracing the transformation of technology. And so the overseas persons exemption is critical, but getting its calibration right, recognising that we're in a dynamic world where other jurisdictions will change potentially the way that they interact with us. And we want to have constructive relationships with everyone, but equally we've got to protect the interests of the City of London in its broadest sense. I hope we can do that whilst maintaining openness as a key hallmark of our identity.
Thank you. Thank you very much. I think I on behalf of all of the participants, I would like to thank you for your remarks, the clarity, some of the specific announcements. I think it will be more than welcome by the industry. And as you offered, we will remain engaged with you, with the Treasury, with the colleagues, and provide our transparent input into this process. So thank you very much.
Thank you, and thanks for the opportunity to be here today. I'd just like to thank my colleagues in the Treasury. Some of them are here today, who've done an enormous amount of work to get to this point. Very often, Treasury officials are not given the thanks that they deserve. So thank you very much for the support that you've given me over the weeks leading up to this. Thank you.
Thank you.
Thank you. Thank you so much. Thank you, Adam.
Well, thank you very much, Adam, and thank you very much to the Minister for speaking to us there. We're going to be moving into a panel session next. So I'd like to invite the first panel to come and take their places and get mic'd up if they need to. And while that's happening, I guess we all heard there the Minister saying that he's ready to right-size MiFID. I guess we're going to be spending much of the rest of the event talking about what that actually means in nuts and bolts, because it's interesting actually to reflect when you look at the July consultation paper. It contained a number of questions for consultation, which in fact were reflected in the closing remarks that the Minister just made. How do we make the wholesale markets work better and more sustainably? How do we make them more fit for technical innovation, and so on? And yet much of what was said in the responses focused on the incredibly detailed and granular questions about double volume caps and things like that, which we've already heard about. So we're going to be spending a bit of our time now talking about some of those details. You might like to know, if you hadn't picked this up, that while the Minister was speaking, the Treasury released a 49-page consultation response, which sets out in more detail some of the announcements that he was making. We had no advanced sight of that, and therefore my panellists will be discussing this without the benefit of that document, but with the benefit of a huge amount of expertise. So I'm very delighted to welcome them. I'm going to come and take my place with them now that we're ready. And our first panel is focused on the fixed income markets, and this is going to take us through till the afternoon coffee break at 3 o'clock, just to give you an idea of where we're going. I'm delighted to be joined by my three panellists today. Ashlyn in the middle, Ashlyn Kohler from the EMEA Rates e-commerce team at Citi, Fabio Braga on the far end from the Financial Conduct Authority, and Matthew Coop here from Barclays. Maybe I'll just invite them all quickly to introduce themselves to you.
Oh, yeah, okay. Ashlyn Kohler, e-commerce, European e-commerce, rates specifically, but in the past I have had some credit experience as well, and plenty of experience with MiFID. You know, Fabio from MiFID.
When you said MiFID, I think I kind of felt it a little bit. Fabio Braga from the FCA. I manage the trading and wholesale conduct policy team, which is responsible, among other things, of the regulation of secondary markets, from market infrastructures, trading venues, to conduct requirements such as basic concern and inducements. And I was part of the MiFID II process when it started, I think, more than a decade ago.
Great.
Yeah, Matthew Coop, and I'm Global Head of Cross-Asset Market Structure at Barclays, and I've been doing MiFID for 17 years. I'm still here.
Well, that's an achievement in itself. In fact, I heard the Minister say that he imagines there's some lawyers who've burned the midnight oil thinking about MiFID II. I can confirm he was correct in that assumption. So let's get stuck right in and think about, first of all, just perhaps, Fabio, I could begin with you, and you could give us the FCA's response perhaps to what's just been said, your background on the direction of travel that the FCA is taking with the wholesale market review.
Certainly, and thanks, Peter, and thanks to AFME for inviting the FCA and for Linklaters for hosting the meeting. So I hope that what I'm going to say doesn't look like a sideshow after what the Economic Secretary to the Treasury said. But I think from an FCA perspective, the publication of the consultation response today on the wholesale markets review is not really the end of a process, but is just actually the beginning of the implementation phase. As the consultation response document says, a number of reforms will be undertaken over the next few months and years. And while clearly Treasury is in the driving seat on the wholesale markets review, in relation to delivering those reforms, the FCA will stand ready to provide, as we did at the time of the consultation, taking advice to Treasury on any of the issues which are relevant for the regulation of secondary markets. So there's a lot of work for us to work, collaboratively with our colleagues at Treasury in implementing the reforms. As you will see in the consultation response, and as indicated by the Economic Secretary to the Treasury, there is, you will see that the reforms will be very different and calibrated differently depending on the market. And I think if I have to summarize really at a high level, equity markets more or less okay with some targeted reforms. Non-equity markets, including commodities, I think we have a great ambition to implement more significant reforms. And those reforms will be implemented through changes to primary legislation. And as the document says, that will be delivered through giving the FCA the power, which currently sits in primary legislation, to deliver those changes. So that will really take a lot of our resources and time over an extended period of time. We want to of course, get on with the reforms and deliver them. We want to do at pace, but also in an orderly way, conscious of the operational and implementation costs that will be for the firms, but also to an extent for the FCA to pay for. What the plan really is, I would just like to mention two things which will be in the short to medium term. The first one, even though equity markets are broadly okay, I think there are some targeted changes we want to implement. We think we have the powers to implement some of those changes when I say equity markets will not just be about transparency, although transparency will be an element of that, both in terms of aspects of pre-trade and of the post-trade, but also some targeted changes in relation to the tick size. And then the important aspect of ensuring the resiliency of equity markets when there is an outage in the primary listing exchange. So that will kind of keep us very busy between now until the end of Q2, and we aim to publish consultation papers on both the equity markets as well as another aspect which was really significant in the consultation response and the consultation document, which is about the perimeter of trading venues. So those are the two things really will be high in our agenda, because we can deliver targeted changes. We don't need to wait for new powers to be handed over to us, and we think there are some important improvements that can be made. Then I would like to mention another thing, which is linked to the broader reform that is ahead of us. And today we put out a news item on the FCA website, which is about establishing a new secondary markets advisory committee, which will support the FCA work in delivering those changes. And while I think the FCA has been relatively good at engaging with market participants, we felt that this is the right time to establish a permanent committee that can advise us and not just provide feedback on proposals, but help us early on in formulating policy developments. So those are the key things that will keep us busy over the next few months and years.
Okay. Well, we will be busy. Thank you very much, Fabio. I don't know, Ashley and Matthew, whether you want to add anything on that. But if not, I think why don't we delve in then, particularly thinking on the fixed income side of things. I think the first topic that we want to get into in a bit of detail is transparency. To the extent that most things are best understood by their history. Maybe the background to this, I suppose, through the MiFID settlement is that back in the early days when some of us were just starting on this, national stock exchanges enjoyed a monopoly for trading in shares, and those monopolies, or so-called concentration rules, were ended. And the quid pro quo for that, of course, was much more transparency in the equity markets, in terms of systematic internalizer, pre-trade transparency, and other quoting obligations. I suppose when it comes to the fixed income markets, which we're thinking about in this session, there's no quid pro quo. There never was a single centralised market like the stock exchanges used to act as a monopoly in shares. There never has been a single centralised market for most non-equity, or really for any non-equity products. And so the introduction of pre- and post-trade transparency obligations in the fixed income markets to look a little bit like those that you see in the equity markets, but without that quid pro quo, always raised the question, is this additional transparency fixing a market failure, or is it really just introducing additional costs and burdens which are not serving a regulatory purpose? Looking at the way that or as I suspect is the case, does the answer lie somewhere between those extremes? Looking at the July paper last year, the consultation for wholesale markets, the paper suggested that post-trade transparency in the fixed income markets was of more value than pre-trade transparency because of the way that the quoting obligations work. That seems to have been accepted by many of the responses, and today's consultation response from the Treasury, I see, reiterates that position and proposes to move forward on the basis that pre-trade transparency is somewhat less valuable than post-trade transparency, and reform accordingly. Ashley, maybe if I could turn to you first on this one. I suppose you're engaging with your clients on the buy side all the time in terms of what they're making of the data that you and your peers are producing. Does that resonate with you in terms of value accorded to data?
Yeah, totally, actually. So, the first thing I should state is pre-trade information is very important. It's essential for TCA purposes. So, where is my expected price versus where do I actually execute? What's the cost of doing that trade? But it's also, in particular in fixed income, very important and is essential for the best execution side of things, whereby pre-trade information is used to ascertain which liquidity providers to go to request a quote from. And that is part of the best execution process. So, pre-trade information is definitely important for the price discovery process, if you like. When we've talked to clients about whether MiFID II pre-trade transparency data has been used as an input into that price discovery process and for best execution TCA purposes, the answer has been very consistent across the board. Every type of participant in Europe, whereby all of them have looked at it, but none of them are using it, none that I'm aware of, are using it in any systematic methodology. And that's because of two key reasons. One being that it's very disparate. You have to aggregate the data across trading venues, APAs, but also SIs who have chosen to show their data on websites to fulfill their obligations through a website, which they can, they're permitted to do. So this makes the task of aggregating data very cumbersome, but also very expensive. And the second reason is the benefit side. So, you do all of that work for all of that cost, and actually pre-trade scope is very limited, more so than post-trade. And therefore, the cost versus the actual benefit was just not seen to make sense. Didn't add up at all. So, it's not like they weren't doing this pre-MiFID, so they've carried on doing what they've been doing and become more sophisticated because generally there is more data available through, and we'll talk about this later, through the digitization of our workflows. And that is, they aggregate dealer price indications, clients aggregate access informations. They also source commercial offerings like composites, liquidity ratios. And what you mentioned at the beginning is actually very key, and post-trade data, because nothing beats data than actual real executed prices, especially in fixed income, where pre-trade it's indicative in the main. And so, post-trade is their own data plus other regulations, including MiFID II, as well as, some other commercial offerings that exist out there.
I mean, I think what we first need to do is a couple of things. We need to take a step back and to look at the fixed income market and how it operates and what data we're trying to use. I think the first mistake that was made is that basically, I think when we look at MiFID, and I wouldn't say this is necessarily from a UK perspective, but from some regulators when you engage, they think that everything's done in an agency manner. So a client is providing us an order and we're working them and trying to deliver this cash security to them. And that's not the case when you're looking at the cash bond market. The cash bond market is trading in a principal capacity, and pretty much nearly all the time we are there trading on risk, trying to obtain a particular bond and deliver it to them through various mechanisms that might come through. And so the critical thing here is that then the fixed income market is leveraging balance sheet, and it's trading in a principal area. And going back to Ashton's point, it's not there's not really an all-to-all where, or to your point as well, Peter, whereas there's not a market where everyone centralizes and engages. Even when we're trading on a multilateral venue, an MTF, which one could argue whether it's multilateral or not, I am providing my price to my client, my risk to my client in terms of the price I want to provide. And so that information is generally quite irrelevant, because they can always come in, and if they're engaged with us, they can actually come in and deal with us. Now, I think there's another point when we're looking at data as well. There's two different types of data. To Ashlin's point, there is the information of data around streaming information that's available for us in terms of putting liquidity out there onto the marketplace, which is not part of the regulation, and I think has evolved dramatically, as Ashlin was concluding, in terms of this available to people, and that's what clients are leveraging. And clients aren't using the pre-trade transparency that came from MiFID. There isn't a fragmentation of liquidity across trading venues, as you see in equities markets. It is about the piece of liquidity that we're providing to a client, whether it be on an MTF or whether it be as us acting as an SI and coming through to that. And I think that's a very critical function of what needs to come out. I think pre-trade transparency, when we look at the WMR, I think it has hit the question on its head in terms of from the MiFID pre-trade data, are people using it? No. Is it providing benefit? No. And I think that is actually, a really good way to move forward, to then actually focus on the post-trade side of things. And from my perspective, to quote an equities industry veteran on a fixed income panel, is actually yesterday's post-trade is today's pre-trade. Because the key thing is actually it's looking at what was the last that instrument traded at. And so then that starts your price formation process. It doesn't mean that's the precise point you're going to be able to see, but it gives you an understanding of what you can do and how you can engage with that.
Okay, so thank you very much, both. So I think we're pulling out loud and clear. I think I'm hearing 2 points there. One is that as regards pre-trade, one is that the pre-trade compliant transparency which is available as opposed to other pre-trade information is not being regarded as valuable by your clients. And secondly, that the production of that data is actually costing you risk. And that risk is because the nature of a dealer market is that you're showing your hand in some fashion. Am I summarising that correctly?
Yeah, I think where we are at the moment and how things are calibrated, I wouldn't say that there's undue risk in the market in terms of where we are right now. But I think if this were to be wrongly calibrated and there would be a clear indication of someone taking a risk position, then definitely there would be an adverse outcome and there would be an adverse point to liquidity. I wouldn't say we're there right now, but people aren't using it either. So it's the critical factor.
Yeah, okay. So Fabio, when I said at the beginning that the panel had not had sight of the consultation response in advance, it seems like I wasn't speaking for all of us. It felt like you'd had some vision on that.
I read it very quickly.
You're a very quick reader. Would you like to respond from a regulator perspective on what we've just heard there?
Very briefly, because when you agree with someone, then there's no point to repeat the same things. But I have some nuances. The first one, I just want to say that, and I think many of in this room know the history of MiFID II was the outcome of a very difficult negotiation where belt and braces were put into it, which resulted in a very complex regime, which overall, however, has preserved liquidity and price formation in markets. So from that perspective, I think job was done. What we are left with, however, is a quite complicated and costly regime to operate. The other thing I wanted to say is that pre-transparency has a great value, but especially in markets like OTC derivatives and fixed income products, it shouldn't get in the way of genuine negotiation between counterparties and the provision of risk capital. And when that happens, then there is a problem in the market. So I think that the very complex regime that we have inherited can be improved in terms of recognizing that I think we can be more ambitious on the post-trade side, and we have to, while we have to be more flexible on the pre-trade. And in terms of kind of looking forward about the things we'll do, because this will be subject to consultation, we'll not kind of implement rules without properly consulting. There are three aspects of the transparency regime for equities which we'll focus on. One is the scope, and that is particularly relevant for OTC derivatives. The second one is what I just said, the balance between pre-trade and post-trade, and trying to get rid of various complications, especially on deferrals, which honestly make the interpretation of the data much more difficult and valuable also from an economist perspective. The third element is the kind of the very formulaic approach to the liquid market determination, which kind of links to the issue of scope, because the two are in effect go hands in hands. So those are the three things we'll look at. And I think the WMR already has set out really the direction of travel, but all of that, of course, will be subject to proper consultation. And the Secondary Markets Advisory Committee will also serve that purpose to bring in industry expertise in-house.
Yeah, well, speaking for myself, I think the idea of the advisory committee is a great one, and having that opportunity for more engagement between policymakers and regulators on the one hand, and all sides of the industry on the other, I think is going to be a great benefit in coming up with rules that are addressing real market failures and needs rather than theoretical approach perhaps that we've seen from some EU rules in the past. So if I was Nick Robinson on the Today programme, I guess I'd be quite disappointed that my panellists are all agreeing with each other. But in the real world, it's quite good to hear a good amount of agreement. But before we move on from pre-trade and maybe unpack some of those post-trade things in a bit more detail, Matt, Aisling, are you satisfied with what you're hearing in terms of the direction of travel?
Yeah, I think, you know, we welcomed the consultation paper from last July. That's in line, you know, your comments now are in line with that. And also we welcome the discussion. We've always found the UK very, very open and, you know, ready to listen to people in financial markets.
Yeah, no, I agree. I mean, I think the devil's always in the detail, so I'll try and have the English reserve. But I think it's been great, and I'd also echo Aisling's comments. It's great to be able to have the engagement with the UK authorities, and I think they have been doing an amazing job asking the questions and trying to dig through to the facts and actually get and to try and work forward in the right way. And fully, I think endorse. I think it's a great, idea that the FCA have produced today in terms of that advisory board and how that can work. It'd be really good.
Yeah, good. Thank you. OK, so let's move on from pre-trade to post-trade transparency. I think there's been a general agreement that that's a more valuable form of transparency. There's no data like the real execution, as you said. That in itself, of course, nevertheless does introduce some risk as well, because you're not just saying about a trade that's been done, but a position which you've acquired. So there is still a need also for appropriate calibration of that regime. And Fabio indicated that that's something which the FCA are ready to work on. Matt, maybe I can come to you on this one first this time. How would you describe your concerns in that area?
A plate of spaghetti, I think, is the best way to start. Because if we look at the current MiFID transparency regime, we have the biggest ever transparency regime ever to hit the planet. And the scope of instruments that it includes is massive. And I think that the critical thing with this is if you have such a massive scope of instruments, and as Fabio pointed out, that the calculations and how this all comes together is very complicated. And so if you have a very complicated way of looking at it, it's very difficult to be able to understand it. But also, when you've got a bucket of instruments this big, trying to get transparency to actually work and calibrate, you're going to have the sort of the standard bell curve where you have the instruments that are on the edges are going to become too transparent, and the instruments that you want in the middle, there's not going to be enough transparency. And so how do you get that calibration right? And so that's why I go back to the place of spaghetti, is where do we start? How do you actually unpick that? How do you untangle it? And I think the critical part to this is looking at the simplification, starting to move forward. And also, another AFME member, I think, is very eloquent in how he explains. It says this isn't actually, what we need to do is we need to be led by the data. We need to look at the data, we need to understand the data, and then we can set the regime. And I think, when speaking with the FCA and HMT, there's a lot of conversation about how do we get the data right, how do we get there in the right place. But I think that's the critical part, because if we get the calibration wrong, there'll be people saying we don't have enough transparency, which you could also agree with. But then there's the other side where if you're providing liquidity and risk on a huge scope of instruments, then undue risk could come into the market, and we're going to have a negative output in terms of pricing that can be delivered to clients.
A plate of spaghetti. So, something I've learned in lockdown, don't tackle one of those immediately before a Zoom call. But there's... Aisling, does that resonate with you?
Oh, yes. at the end of the day, we're in Europe and in UK. Does everyone really care where some obscure Asian government bond traded? Not really. We really care about European markets. That's where the majority of the flow is. That's where we'll get the biggest bang for our bucks. And then it's just narrowing down from there, which European markets do we want to focus on? Where, again, can we capture the most amount of trading and provide the greatest value back to, all institutions within financial markets to help liquidity further? It's like oiling a machine. It's just, you just keep it running smoothly without any breaks as such. And same with corporate bonds. It is generally an illiquid market, but if you speak to clients, they're really desperate for information, traded information on corporate bonds. They are absolutely understanding of the fact that they don't want, and they want to be able to protect, let's call it, the block sizes, the illiquid trades, but it's for their benefit too. It's, to ensure that, it's not trading in those types of trades, it's not going to cost them more. And that's coming from undue risk that would be, taken on by market makers. So it is really about risk and scope.
Sure, okay. Fabio, you've made some comments about this already. Yeah. Is there anything you'd add on?
Maybe I can inject a little bit of disagreement, and then the panel becomes more interesting. But I think, in general, I agree with the remarks made by my colleagues. In terms of post-trade data, I think there are three dimensions. The first one is access. And I think we'll cover a little bit access, where price is an element of it in a second. The second element is timeliness. Information must be there on a timely basis to be factored into investment decisions, pricing, best execution, and so on and so forth. The third one, which is also very important, is the content of the information. And it's not just the price and the volume, but is to be able to really disentangle liquidity from trade reports. And I think there is a lot of work that can be done in that space, this third one about the content information and how it can be used, post-execution to figure out where the liquidity is, how the market would move if I send an order of certain size. And that improvement, I think, doesn't necessarily need to come only from a thicker rule book, but can come also by leveraging or harnessing existing standards where the FCA can facilitate further adoption of those standards to make sure that more or less we all interpret certain trade events in a certain way, which then result into certain type of trade reports. Hence, you have a greater comparability of the data. But all of that, of course, then requires still that the information is put out on a timely basis. I think some of the calibration in MiFID II were very complicated and difficult because we didn't have the information about what is the right length of a deferral. I think there is space for being more ambitious in that space, provided we give some protections to liquidity providers. But I think there is the path is one where we enhance post-trade transparency, not just in terms of the content and access, but also in terms of the timeliness of the information. I think that is essential for us.
As Fabio knows, and I think a few people in this audience know, data standards is a serious soapbox of mine. I have a few. And I think no more is focused into fixed income, because fixed income it's not one size fits all within that, and bonds trade in a number of different ways. And there's a number of different ways in how you reflect things. I've been involved in hour-length conversations around what is a price and how a price should be reported, because there's different ways in how that come together. And I fully agree with Fabio. I think we need to get the data standards right, and we need to make sure we do that. But the critical part is, how do we get that application? And I think that comes from industry dialogue and conversation and being able to work through these to get there. That then also leads to better data and better transparency, and also, I think, gives us a really strong power to actually come out with the right end in terms of how do we calibrate and where do we get these deferral periods right, because we can then look at the impact and we can review and have that discussion. And I think that evolution process, I think, is really, really important.
Okay. So it seems like we're asking ourselves the right questions. We just don't have all the answers yet, I think is perhaps where we are. So Fabio, your comment on data there is really helpful, I guess, thinking about the access to the data, the timeliness of that data and what data it is, actually. All data is not created equal, of course. We're going to come on to cost of market data in a moment. Before we do, though, related, I suppose, to access and how you can get to this is this idea of the consolidated tape. We heard this mentioned by the Minister again today. It's a concept that's been around for a long time. On the other hand, it's only a concept, I think, the consolidated tape for now. So I wonder why that is, and what are the difficulties with data quality and usability which are driving the debate in this area. Maybe, Aisling, can I come to you first on this one?
Yeah, I mean, we've lived with MiFID II in fixed income now for 4 years, and aggregating the data remains, challenging and expensive for all market participants. And what's made it very challenging is that even across the various APAs and trading venues who are all reading the same rules, data presents itself in a way that may vary across those channels. But not only that, there's been no real incentive for those providers to really provide the data that makes it usable. So, an ISIN is delivered and they will then deliver an ISIN to you. And for bonds, when a trader looks at that data, they don't know, contrary to all belief, they don't know an ISIN off by heart. They need a ticker or a maturity date or a coupon or both or three things. So the data was difficult to decipher, and that's bonds. We haven't even got to derivatives. And then there were all these acronyms which made it even more tricky, whether it was the deferral or where the trade was actually done, and what type of deferral it was. It just made it impossible to really understand and to aggregate and make it meaningful to a trader. Plus, it was expensive, frankly. So as a result, no real consolidated tape provider emerged, and there was no demand either. And the recent EU proposal sort of has that as a much more core, basis and principle of their consultation, as of you, actually. They've gone maybe a little bit further where they will be mandating data collectors, so venues, and APAs, to deliver that transparent data to the consolidated tape provider on a non-commercial basis in non-equities. So, and that's quite a welcome shift from previous. So it means that, they're willing to put their best foot forward and lead the way. And I think, in the UK, that's probably going to be required as well, like a real sponsorship from our regulator and the Treasury.
I completely agree. I think, to me, the consolidated tape is about the democratization of data. It's embracing what transparency is there, is to actually enable price formation out into the marketplace, which I think is a really positive step forward if controlled in the right way in terms of protecting undue risk. And, there are, as Aisling said, there is a lot of fragmentation of data trying to make it technically very difficult to actually combine it together. And there's a huge cost to it as well, across fixed income and in other asset classes. And I think the critical thing is, buy side and sell side. I think all of us in the industry actually are supportive of a consolidated tape for fixed income, because I think it's going to enable us to be able, for this time, to get hold of the transparency, to really understand and use it.
Okay, great. So we've heard there's a desire for a consolidated tape. There's a desire for the regulator to help make that happen. You've indicated, Fabio, that from the FCA side, there's a desire to see post-trade data, which is, more valuable and more useful. The minister's just told us that you're going to be given a power to make it happen. So, over to you.
We'll need to see what that power exactly looks like, of course. But it's a very sensible approach. It's a very technical area of financial regulation, and I think those things should sit with the regulator in line with the future regulatory framework. The precondition is always for a CTP to emerge is that the underlying data is what we've just agreed. So that is the precondition. I'll make a few observations in no particular order. One is that as a bureaucrat, I have the FCA objectives as kind of the what drives my work and our work, and we have a market integrity objective. We do have consumer protection objective. We do have also a competition objective. So we need to have regard to all those objectives across all pieces of financial regulation, including the establishment of a CTP or multiple CTPs. So I think that is essential for us. We cannot kind of just disregard that objective. Of course, looking at with the benefit of insight, since there is not a single CTP authorized, that is not clearly the greatest success of MiFID II. And the way we see it is that the economics of market data is complicated. It's not like any other service or good. It's a quite unique one. And I read with great interest the AFME study on fixed income, which kind of says very clearly that there is not just an issue in relation to the price, the terms and conditions, the licensing, and to a large extent the ability to aggregate in equities, but that exists in fixed income. And that's not surprising because the economics is very similar. So there is data which has a value, has a certain way in which it is consumed, and is provided by certain firms. And so it's not surprising that we see similar issues across different asset classes. So I think in terms of what we'll do next, leaving aside the establishment of CTP, which, as I said, is going to be a very complicated piece of work for us and will depend on the powers we have. But we have, in effect, two tools. The first one is work within MiFID and reforming MiFID. The other one, as we are a competition regulator, we'll look at those things also from a Competition Act perspective. We put out a feedback statement on the call for input on market data. So over the next few months in spring, we will do a data gathering and analysis exercise to look at across all the elements of what makes market data what it is, which, as I said, are the price, the terms and conditions, the licensing, the way you can access data which is supposed to be free of charge. So all those things are essential, and as a competition, having that competition objective will look through the lens of competition as well, not just MiFID II.
Okay. By the way, I should say we're covering quite some ground of technical topics in this panel. We're hoping to keep some time at the end of our hour for questions. So do think of questions you'd like to ask on all of this. And on our next topic, I expect that's one where there may be some questions, which is the cost of market data. You can't get very far into any discussion about market data without this coming up. Fabio, you've mentioned it already, in fact, but perhaps I can come to you first before we hear the market forces of supply and demand to my immediate right, to give your reflection on that.
Well, I think just to kind of maybe further elaborate on what I said earlier, clearly price is perceived as one of the issues not just around data consolidation. I think that is a manifestation of the problem. It's about the consumption of the data, and whether the current market clearing price is the one which maximizes the benefit for all producers and users of the data. And as I said, we are going to undertake further work on that. And the plan is really to report back to the industry towards the end of the year. So I think if we have another panel this time next year or towards the end of the year, then I think I'll be able to kind of give more details. Price is an element, and I said I think my kind of direct experience in looking at the terms and conditions and licensing, I admit that they're very complicated, but that's not surprising given the nature of the service provided and the intellectual property that exists around market data. All those things will be the subject of really our review within kind of that piece of work. Within MiFID II, we'll look at largely the kind of the quality of the data, and then we'll also look at the kind of the timeliness in which it is provided. And of course, I think we have broad powers in relation to free of charge data, which we'll also look at.
Well, very much look forward to keeping the conversation going and talking about it some more later in the year when you've got some more work done. But we don't need to wait till then to hear a market view for now. I suspect we're not going to hear that you'd like to pay more for your data. But Matthew, what's your view on this?
So when looking at market structure issues, I'm a strong believer in terms of the first question you need to ask yourself is what's the right result for the end investor? And what is the function and what is actually happening in the transactional life process? So if the market data is being created and it's being distributed, and we think transparency is a good thing, that is a great thing to happen. But what we shouldn't have is people who are not providing risk in the market, which is of a high cost to all of us, as we all know, and who are basically essentially aggregating something and charging an exceptionally high margin to do that. Because to me, that is not the right result for the end investor. That is actually just causing additional cost into the transactional flow process and not delivering on the benefit that needs to happen. Because buy sides need to acquire this data, sell sides need to acquire this data. People wanting to trade liquidity want to get this data. It's perfectly reasonable for someone who is providing a service to be paid. I think the critical thing is what's the reasonableness to this. And these are in some cases they're regulated entities, but the market data provision is not a regulated provision. And I think if they were regulated in the same way as we are with the financial services we provide, I think there would be a wholly different outcome. And I think it's something that we definitely need to look at, because I don't think what is happening here is the right result for the end investor.
Yeah, I mean, I agree with everything Matt has said, obviously. And all of us in the room probably, know or work in institutions that complain about the high cost of data. But, in fairness, just to look at the other side of, like, the data actual vendors, fixed income as an asset class has incurred a bigger increase than other asset classes as per the AFME paper. And that's for a very good reason. We've been through a big digital evolution prompted by MiFID II, in fact, and it was the order record keeping requirements, it was the trade reporting requirements that really led to participants sitting back and thinking, okay, I'm going to have to digitize my flow. There's no other way of doing this. And how do you achieve that? Through either trading electronically or through processing electronically. And that's exactly then what happened. And as you put more through electronically, there is more data. And that data is then very useful in its input to the best execution transaction process in general, and that whole workflow. And that meant that the providers had to suddenly also step up and deliver data quite quickly, large amounts to a large number of participants within Europe and probably broader. So, you know, the demand was higher and a lot of pressure was put on these vendors. But I think Matt's point about the fact that there's no real transparency in the pricing of that data to you or to our peers, to the market in general, and it's not regulated in any way, makes it vulnerable to, you know, larger increases than necessary. Or maybe they are necessary. Maybe you do your review and you say price points where it should be, you know, and
Yeah, I think the kind of market data, kind of reforming market data, it's a really balancing act and preserving the incentives for the producers of data to produce high quality data. I think that is an element of the equation really, and we recognize that.
I think that's a critical point, is what's the role they're doing? Are they just aggregating feeds? Obviously high quality is critical, but if they're just aggregating feeds and chucking it out the door, what's the appropriate level to be making off that? If you are taking multiple feeds, feeding quantitative analysis, looking at indicative liquidity scores, and putting some really intellectual thought and power over the top of that, that deserves also to be recompensed appropriately to the strength and rigour that's being put onto that process. And I think that's the balance that we need to sort of look at.
Yes. I think just stepping back and from a philosophical perspective, calls on the regulator to regulate the pricing of services in the financial markets is something which we don't often hear. So I suppose we need to ask ourselves as well, you know, what is it about the world of data which, you know, which marks it out as different? I think, you know, the absence of risk and the utility nature of it and some of the other points you've made perhaps answer that question, but one which I suppose also we want regulators to approach with caution, right, in terms of interfering with the pricing in the market. It's 5 to 3. I've got a couple of other questions up my sleeve should we need them, but I wonder if there's anyone in the room who's got any questions they'd like to raise. We have some roving microphone facility if anyone would like to raise a question on what we've been debating so far in this panel. Yeah, I think you're right. We've fixed it really. Maybe I'll ask one more. I mean, you took us back actually, Ashton, just then to the fact that, you know, all of these rules we're debating aren't happening in a vacuum. They stem from the way that MiFID operates. To what extent do we think it's more important to get these rules right in the UK, or is it more important to remain aligned to those in Europe from an efficiency perspective, given the cost the Minister also referred to of building the systems that we have? Do you see those as something which are in tension?
I mean, there's no competition really. I mean, you know, it is much more important to create a transparency regime that fosters liquidity and, you know, creates momentum in the market, and as well as being safe, of course, than to try and thrive for equivalence. I think the UK has a great opportunity to think about just a clean slate and, you know, where can we take this?
If I may add something
please do, yes,
that.
and then we'll come to the question just there.
I think there is a bit danger in looking at things like point in time, snapshot, and now it's all about divergence. But in reality, this will kind of this reform of our markets in the UK and the markets in the EU, but it goes beyond that, you know, in the US as well and other markets. It's something that happens over time, and there's a lot of learning and you know, looking at what they're doing, and if it works, why we shouldn't do the same thing, and vice versa. So I think over time, that issue will hopefully go away, and actually there'll be some good learning on both sides of the channel. Well, actually, Europe has done this thing. It's very good. Is there any reason why we shouldn't do the same? And I hope that is true on the other side. I think it's true because I know the people who worked on MiFID up until we left. So I'm optimistic that that kind of virtuous cycle where, you know, you look at each other's rule book and tools you want to use to achieve really the same objectives will take us to to an extent, some convergence in certain areas and still divergence in other areas because the markets are different.
Yeah, I think it's a very good reminder that we should have a sort of growth mindset rather than the sort of static mindset that maybe was implicit in my question. There was a question just over here.
Thank you. Hi guys, Christian Benson from Bloomberg. I just had a quick question for the panel about the issue of timeliness, and in particular around the consolidated tape market data. How much of an advantage do you think it might be if the UK were to get there before the EU? And just maybe more in general, how does the panel think about what's going on in Brussels right now with the review of MiFIR and the implications for that on the UK reforms? Thank you.
I much prefer us not to race to make sure we get there in a considered way and deliver something that's useful. I think is critical. So whether the data, whether the consolidated tape from Europe or the UK is first or second, we will still, from my perspective, we'll still be taking both tapes because it's trading which is related to the geographical continent, and I think it's really important that that is fed in. And I really think that delivering good quality data that the market can use is much better than actually delivering something that's rushed and not thought through and can't use. And from the European side of things, I think, as Fabio said, a number of his peers in Europe, have been involved in this conversation for a long time, and it's an ongoing discussion, and there are different trends and different parts of the market needs to come in. But we are all discussing the same topics.
Yeah. I mean, UK is just one and EU is 27. Just based on that, you would think UK, is able to get to a decision-making conclusion faster. But again, Matt's absolutely right that timeliness in terms of delivery is not what's going to drive this. We just want to get to the right end point.
I can sense a little pressure.
Yeah, I was going to say, no pressure.
I think, well, first of all, Europe has demonstrated that on certain things you can find agreement and develop the market and introduce things quickly at pace and in a way which improves markets. So. Clearly, I agree with you that it's kind of a statement about the fact that, you have to bring together many more participants to the table. I think I would echo what Matt said about, it's important to get it done. However, I recognize that, in effect, we are looking at each other. So I also recognize the fact that they are developing a CTP is, at the same time, interesting for us because we look at what they're doing, and I think there were interesting things in the proposed MiFIR, and also an incentive for us to, kind of deliver our own, because it's a piece of market infrastructure which is important. So I wouldn't simply say that, it's just about getting right whenever we get it. But the fact that they're doing, I think, creates a positive incentive for us to do something along those lines.
And in getting things done quickly and efficiently, I'm sure you'll remind us that the future regulatory framework, taking this out of the hands of parliamentarians and giving it to the regulators, will help us to do that all the more efficiently.
When that process is finished, so we which is kind of will be part of our work, and I think will also keep you busy, law firms, looking at what we are doing there. But yes, I think that's really the ambition is to be able to deliver.
Please do mention to my senior partner just how busy the regulatory team is going to be. That's going to be to mention. Well, it's 3 o'clock, so we must draw our panel to a close there. Thanks very much indeed to Fabio, to Ashlyn, and to Matthew for a really, really challenging discussion actually to cover such detailed topics and get through so much and make it at the same time so interesting. So thank you very much indeed to all of the panel.
Thanks, Pippa.
Well, welcome back to the second part of our conference today here at Linklaters. Maybe if those in the room could quietly take their seats now. We're already streaming online, so it would be great to make a start. Thanks very much indeed, everybody. So welcome back. So we fixed the fixed income markets, I think, before coffee. So no pressure, but we're expecting the same now in the equities market. And so without any further ado, I'm going to pass you over to our expert chair from Credit Suisse, Elisa Menardo. Thank you.
Thank you very much, Peter. And thank you, everybody, for coming back from the coffee break. It's always reassuring to find there's people in the room, even after that. And you made the right choice, because we've got the best people you can get in London to talk about the changes that are coming for equities markets. So first of all, on my left, Claudia Traufler. She's the head of capital markets for Treasury. She actually had the benefit of knowing what was in the paper, which, while the rest of the team have had to read it since 1:30. So we'll start with her. Next to Claudia, you have Richard Worrell, who's head of trading at Janus and the head of the equity trading group at the Investment Association. Next to Richard, Stephen Mcgoldrick, who most of you know, but for the few who don't, is currently working at BNP Paribas in regulatory affairs and is the chair of the AFME Equities Board. And then last but not least, we have Harry Edis, our host from Linklaters, a partner in the Linklaters regulatory practice. So with this team, we hope to spend the next 50 minutes looking through the changes that Treasury is proposing for the equities markets and what they mean for practitioners. So I'll start with Claudia on the basis that she actually knows what's in the paper. What can we expect?
I'm not the only one that knows what's in the paper in this room. I have some of my team here with me today, and Fabio and Edwin, who we work really closely with, but please be kind to them. No, thank you very much for having me today. It is a great pleasure to be here and actually meet some of you face to face for a very, it's been a very long time. As the Economic Secretary to the Treasury said earlier, we're very excited to be publishing not only one, but two consultation responses today. And whilst I'm going to focus on the Wholesale Markets review in this panel, that's the subject of this conference, we're also publishing the prospectus regime review response today, setting out next steps on both very important reforms. Can you hear me? I feel like I'm having... Yeah, okay, good. So yes, I realise that you haven't had much time to read and digest the content of these responses. And I, for one, am really grateful that you stayed actually behind here in this panel to listen to us and not rush back into the office to dissect the responses in the context of it line by line. Not that you could actually rush back into the office in the current circumstances anyway. But I will promise I will do my best to set out some of the highlights of the response in relation to equities markets reforms. Before I do that, I wanted to thank... Okay, I will then. I just wanted to thank AFME, its members, and more widely industry stakeholders who responded to our consultation. I realised and recognised that there was a lot of work and a huge amount of effort from all of you, especially during the summer month. Sorry about that. But really, we are very grateful for that, and simply put, we couldn't be here today without your invaluable input. So, on to the highlights, shall we? The Economic Secretary to the Treasury set this out back in November and reiterated it today. We are going to delete the share trading obligation and the double volume cap as soon as possible when parliamentary time allows. I'm not going to go over the reasons as to why we're doing that again. I think that's pretty clear. The key point to make, I suppose, is that this is really the right thing for UK markets, and respondents overwhelmingly agreed with that. Perhaps worth mentioning at this point, we are not removing or deleting any elements related to the delineation between bilateral and multilateral trading. I know there were some questions around that because those elements sit within the STO provisions, but our intention there is very clear. We're not going to move backwards on this. Beyond the STO and the DVC, and again, as the EST set out earlier, we will allow systematic internalizers, SIs, to execute at midpoint between the best bid and below LIS. When we published the consultation, we considered at that point whether any constraints were necessary, whether we should limit it to the SI's quoted price, and after careful consideration, based on the feedback received, we concluded that might not be necessary to incentivize meaningful quotes. Finally, we will delegate the pre-trade equity waivers to the FCA as a priority, and again, when parliamentary time allows. You will hear me say that phrase a long time, many times, I'm afraid. But this is in line with the broader direction of delegating firm-facing requirements back to the expert regulators. And we see this particular area as a priority, as, for example, reference price waivers and the changes to that will be crucial to the work that industry and the FCA is considering to mitigate the risks related to market outages, for example. So, on to next steps. As you know, to enact the WMR reforms, changes need to be done to existing legislation as well as regulators' rules and guidance. What we're setting out today is that it is our intention to deliver the most important legislative changes as a priority when parliamentary time allows. And we're making clear as to which changes are those. But separately, the FCA has also committed to progress the reforms to the parts that already sit within its rule book. And I know, but I'm sure colleagues here in the room will confirm, the equity regime will be a matter of priority to them. For the changes that require legislation, but that can wait for the implementation of the future regulatory framework review, we will do just that and wait. We think that this step-by-step approach will ensure that we can address the most burdensome requirements now, while ensuring that we maintain a coherent and agile regime for wholesale markets, one that delivers a fair and outcome-based framework, one that supports openness and competitiveness, and one that maintains the highest regulatory standards. And I'll stop here. I said too much already.
Thank you, Claudia. I'm going to come back to you on when parliamentary time allows.
Timescale, I've written down. Timescale.
But before we get there, one of the things that you mentioned is making changes to the share trading obligation. And some of the non-lawyers in the room might think, wasn't that dealt with last year when Brexit became effective? Why are we suddenly worrying about the share trading obligation again? Harry, you're a lawyer. Can you tell us why people are worrying, why we should be worrying, and why this keeps being announced as something important?
So I was going to say the share trading obligation is dead. Long live the share trading obligation. I think I now need to put, and the share trading obligation is again dead, from what you say, Claudia. But just to answer your question, Elisa, so the share trading obligation was onshored as part of the onshoring rule legislation of MiFID, so effectively it applied in the UK to ensure that UK equities were traded on trading venues. There was then effectively a waiver which allowed you to comply with the share trading obligation, provided that you traded either on a UK trading venue or any European trading venue or SI. And then also what was in there was the original sort of equivalence to third country regimes as well, where equivalence had been granted. Now that power actually formally expires at the end of December of this year. So actually, I think everyone's just said the word timescale. So to the extent that parliamentary time does not allow before the end of this year to get that done, could we expect some sort of extension to the current regime, or has there been any thinking around how that might play out?
I think he's looking at me. Okay, what can I say on this one? Well, you know what our long-term objective is. We believe in open global markets and in firms' ability to choose where to trade, and that's our sort of guideline and that's why we are deciding to remove this particular requirement permanently when parliamentary time allows. And separately, it's going to stick, this phrase, I'm telling you already. Separately, we know that the FCA used its temporary, as you just set out, its temporary transitional powers to allow firms to continue trading all shares on EU venues and SIs, and that was incredibly important and crucial in mitigating any risk of disruption at that point in time. And I think it's fair to say that everyone welcomed the action that the FCA took then, and by everyone I include myself and the Treasury. But yes, we understand that there might be concerns. We know them, we are aware of them, and I'm afraid that's all I can say at this point in time.
So, in summary, it should be dealt with by the end of the year, but if it isn't, you'll do something to make sure we don't have a problem. You haven't said it, I've said it.
You have said it.
Great. Well, the next thing that was watched, because that was not so much, that hadn't been so trailed before, was whether or not UK SIs would be able to execute a mid in all sizes. And the Economic Secretary and you have just confirmed that that will be the case. But Stephen, why is that so good? Why were we watching it so much?
We're watching it because if you've got a natural buyer and a natural seller, the price that they should trade it at is the mid price. Why should one benefit over the other? And for those that aren't familiar with the markets, the mid price is the price right in the middle of the bid and the offer. It quite often is just used as the price of the stock. To prohibit SIs from doing that is to tell them that usually they've got to disadvantage their client and make extra profit for themselves, which is a bizarre way of trying to help the ultimate objective of returning investment returns to the clients of the buy side.
Richard, you're nodding. That means you agree? That's welcome from an investor's point of view?
Absolutely right. I actually don't think I need to say anything. But look, it's just the most fair outcome. I think its midpoint is vital, and to have restrictions on it in any way, shape or form is utterly ridiculous, to be honest. I promised I wasn't going to get on the soapbox today, but I may well do. But look, it's vital, and I think there's probably two reasons. One is choice. So as you alluded to, we want the choice. We have different execution, sort of aggression levels or sort of time scales, different scenarios that we want to trade in, and midpoint is vital for that. But the key to it all is that fair outcome. It is really, really simple. There's a buyer and a seller that are happy to transact at that exact point in time. The midpoint is absolutely the fair outcome. So it's really, really simple. All of these regulations and all of these situations should come down to how do we work for our clients? How do we save clients money? And that's what this does. So.
It's worth saying that not all trades will happen at mid-price.
No,
because
absolutely
not all
not.
buyers and sellers are natural buyers and
Exactly.
sellers. The reason there's a spread is that the person that's making that price is receiving effectively an option premium from the marketplace. They're receiving half of the spread as an incentive to be hittable.
Yeah.
And that is economically rational because they're not a natural buyer or seller. They're I wouldn't say ambivalent to trading, but they're not motivated to trade that stock at that particular point in time. As soon as both parties are, then the mid-price is the fair one.
Absolutely right.
Great. So there we have a better result for investors, but we also have simplification, something that makes the market, hopefully in the longer run, a bit cheaper and a bit simpler. And I think what I'm thinking about here is the possible splitting of the systematic internalizer obligations from the reporting obligations, so that people can report for others if they want to offer that, regardless of whether they're a systematic internalizer. That's something that's come out of the discussions throughout the summer. And I know not everybody will have seen the details. So Stephen, can I call on you again?
Yeah, absolutely. The reporting obligation is, for everyone's benefit, is just who is going to make sure that the trade that you and I have just done becomes public and that everyone else can see it. And in days gone by, when we started out, it was the sell side reports, and it was just understood that that was the case.
Yep.
It very literally went unspoken. We knew that's how it worked, and we proceeded with that. MiFID came along and decided to codify it, and said seller reports unless one side is a systematic internalizer, because that tends to be the sell side, and omitted the ability to say unless the parties agree otherwise, which is what the previous legislation had said. And that unless the parties agree otherwise had been an implicit agreement between parties. And so no longer could you just say, don't worry about it, I'll do the reporting. Because your client would quite rightly say, but are you a systematic internalizer? And in some cases, sell-side firms are not, for lots of reasons. And the buy-side lawyers became concerned, quite rightly so, that they could have an obligation to do the reporting and none of the mechanics to do it. It wasn't set up for them to create that. And this linkage of who does the reporting to the systematic internalizer status was, I'm sure, an innocent mistake. I don't think there's anything untoward about it, but it hadn't appreciated that not all sell-side would be systematic internalizers. So it created a problem where there wasn't one previously. And the proposal that's come from a number of trade associations now is that they should be decoupled. Just as simple as that, we can't, unfortunately, go back to the point where we had implicit agreements. Our lawyers won't let us do that within our firms. But we can go back to a situation where we say, we'll put our name on a list, and as long as our name's on the list, the FCA, the Treasury, will say, if you see a name in that list, they'll do the reporting for you, don't worry about it. That is so much easier because systematic internalisers aren't systematic internalisers in all stocks. So you had the absurd situation where, theoretically, when doing a trade, there had to be a reconciliation to see if that client, that counterparty, was a systematic internaliser in that particular stock. We say, do away with that and just make it what we're calling super reporter or uber reporter or reporting responsibility. If you're on the list, you do the reporting. And it's as close, I think, as we can get back to the situation we had before, which was not a problem, where the sell side does the reporting. So hopefully, I think that's going to FCA consultation or FCA dialogue with the marketplace.
You have clearly gone to the right page in the consultation response. Yes, no. From our perspective, I mean, when we put out the consultation out, I mean, we knew that there was a need for greater clarification and simplification in this area, and these proposals are certainly interesting. I think from a Treasury perspective, what we cared about is that whatever proposals that are implemented and taken forward, they work across, the market, sell side and buy side alike. But yes, as you said, these proposals to be taken forward do not require legislation, so this will be a matter for the FCA to consider further.
Claudia was saying they need to work for the buy side and the sell side. They clearly work for the sell side. How about you?
Yeah, I think so. I have to say there was probably a little bit of buy-side sort of cynicism initially around the super reporter. I think when all the sell side try and sell you something, you become a little bit nervous and cynical. But I do think it does make a lot of sense. I kind of did a bit of work on this to think about it more and to explain to everybody how complicated it is. And actually, AFME have got a document explaining the reporting regime, and it's 52 pages, which actually tells you something. And there's actually 9 different ways. If you trade off venue, there's 9 different sort of reporting scenarios, and if you trade on venue, there's 5 different reporting scenarios. So that sort of gives you a clue as to the difficulty that we've got at the moment, and it isn't clear. So I think we support simplification of all of these things, and I think that to go back to that sort of older system of the seller reports, it's just so much more straightforward. We know on each scenario who it is, and in that it really be just 3 different scenarios in that example. So I think we support it.
Yes, you had me worried there because I was thinking, I'm sure I've seen the super reporter summary and it's no more than a page and a half. So when you said 52, I was wondering what have I missed.
You should have seen how worried I was when Claudia said there were 2 different... I was like, hang on a minute, there's 2 things I should have read earlier.
So simplification is definitely good for buy side and sell side. Is that good for lawyers, Harry?
Not so good for us, no. I'm sure it'll please a lot of you to say that the simplification is the death of our practice, but we definitely support this. I mean, we've had to advise a lot of clients on this, and a lot of clients have decided to become SIs solely so they can do the reporting regime. That it's sort of almost as a sort of perverse incentive to then get into all of the other sort of obligations of the SI, and the transparency doesn't really seem to be the right way to incentivise the market. So certainly for us, it seems to make a lot of sense.
So, Richard, I was going to come back to you because earlier when we spoke about the elimination of the double volume caps, it was quickly said, we all know why it's a good idea, so no need to go into it now. But actually, we know that it's not a view that is shared across the entire continent. So can you run us through again why it is a good idea to get rid of them?
Yeah, I think it goes back to the midpoint before. You know, it's the fair outcome. You know, you have to understand these are. I think, and one of the things we were joking about before actually was the marketing around it. You know, there's a lot of talk about dart pools and about how that's all. Oh, hang on, they're trading in the dart. What's going on? We don't know what's going on. And actually, if you could rebrand them as just sort of block crossing venues, midpoint crossing venues, it would be a lot more. It would be a lot more palatable maybe to the sort of regulators. One thing I would say, and when I read all of the consultation responses from the European Commission, for example, I tried to put myself in their shoes and the different sort of parties, and I will agree that we definitely should look at the market quality metrics. So we should look at spreads, we should look at touch sizes, fill sizes, all of those sort of things, and check that trading in the dark or off venue is not having a detrimental impact. But I don't think any of those things are true. When I look, the exchanges, the venues, the vast majority of business does still go through there. Spreads are as tight as they've ever been. Our transaction costs are as low as they've ever been, really, to the best of my knowledge. So I think we're in good shape. So I think actually we should be completely supportive of scrapping those double volume caps.
And the FCA sorry, Stephen.
I would say the double volume caps were introduced very specifically just to try and limit the success of reference price waiver pools. It was deliberately because there was a successful lobbying of the European process to say that lit, transparent markets are good. Dark is something we've got to tolerate if we must, but let's make sure not too much of it happens. In a similar way, the SI regime was created just to put a regulatory wrapper around OTC trading, which we'd been doing, since the market started, and that was perfect. It should be regulated, it should be understood, it should be a designated sort of status. But it also, in some places, has morphed into some sort of way of limiting the amount of activity that is done under that badge. These badges, the reference price waivers, which are going off to the FCA, they should be about making sure that the marketplace is fair. It shouldn't be about trying to decide which market mechanism a participant should prefer or be forced to use in the execution of their trades. And I think that what we've heard earlier and what I've read in this document is telling me that the UK understands that. We heard earlier that dark is not dodgy. It's a dreadful name, as we said just now, but dark is just a normal mechanism of any market, not just the capital markets. If you're trading in very large size in a fruit market, you're not going to announce it to everyone. You're going to do it quietly. And the same is true of capital markets. So, I mean, this is a very, very encouraging step forward that the Treasury gets it. They understand how markets work. So thank you.
And the other thing is the arbitrary nature of them. If there have to be restrictions, if you have to think about that, let's have an evidence-based decision as to why we do that. Let's not just say, well, it's 7 or it's 8% or whatever it is. Let's actually have an evidence-based decision that backs that. But look, I completely agree with Stephen. The key thing is remove restrictions on firms' ability to execute transactions to ensure that market participants can get the best outcomes for investors. That's the key, the best outcome for investors.
Yeah, and that's something I think we can all agree on. So DVCs is another one of those where colleagues might wonder, we've been talking about DVCs for 2 years. We haven't worried about them in London for a while. So that's where I go back to a lawyer on the panel to say, yeah, we haven't been worrying about them for a while. So why is it such a big announcement that they're going? Haven't they gone?
So they hadn't formally gone, but as you said, that it wasn't really something that market was worrying about. So just to key off what Stephen was saying earlier, they're effectively a restriction on the use of a waiver. So there are the reference price waivers, and effectively this applied, or the double volume cap applied a restriction that you couldn't trade more than 8% under those waivers across the markets as a whole, or 4% on any particular market. And again, that was onshored into the UK, and the FCA, under UK MiFIR, there was a particular a particular provision which allowed the double volume cap to exist and for the waivers to be suspended. And what the FCA announced, I think it was March last year, was that they were not going to apply the double volume cap effectively, so that that did not apply to the UK equities trading. But the power still existed in there, and would exist for another, 4 years from the end of the transition period. So it was going to be able to carry on, and if at the end of that period, if nothing had happened, then the double volume cap would have magically then reappeared. But fortunately, on the basis of what has been announced today, that is not going to happen.
As long as parliamentary time allows.
One would hope there's a little bit more time for this one, but...
One other thing that was mentioned earlier is also in connection with the reference price waiver, and is using a different reference point. And people might wonder why that's worth a minister's time. Isn't that extremely technical? Why was it mentioned? Richard or Stephen, who wants to go first?
Go on, you can lead.
I think there's at least two reasons that it's important. At present, if a trading mechanism that uses the reference price waiver to avoid having to publish its orders before execution, it has to use the best bid and offer from the most relevant market, which is invariably the national exchange. That data, for them to use that data, it can be very expensive. They can bring that data in to their platform and be charged a lot for it, a lot more than other users, because the supplier of the data sees it as competition, that they're enabling someone to do trades that otherwise might happen on their platform. So having the alternative to say, well, your data is too expensive, I will go somewhere else, as long as it's best execution in a liquid market, then that rebalances that imbalanced negotiating position on the price of the data. I think also it talks to the resilience of the market. At the moment, when the prices from that most relevant market stop being promulgated because the market's having some form of technological difficulty, the reference price waiver pools have to stop trading because they're not getting the input. If they're put in a position where they can take a feed from more than one place, they've got an inbuilt resiliency. You've got rid of a single point of failure, which I think we'll come on to speak to more generally in terms of market resilience. But I think that's the two key reasons that I think it's of significance.
Yep, I completely agree.
Let's talk a bit more about avoiding outages. EBBO is one way in which we can make the system more resilient, but the paper mentions that there should be more work done to increase resilience and diminish the impact of outages, because outages will happen. We all hope they won't, but they will. So what could we do to make the system more resilient?
Do you want me to lead on that if you led on the other one?
Yep, I'll go again.
I was going to go. I did say I would go because you went on the other one. Yeah.
Apologies. Go in then.
Yeah, look, I think it's great that it's in the paper because it definitely needs assessing. I think from an investment association point of view, we're going to try and put forward a position paper, which hopefully will speak to a lot of this. There's some fairly obvious things that we can do around, best practice in terms of, look, data needs to be halted immediately, and there needs to be a more standardised reopening messaging system, things like that we can do. But absolutely, the reference price waiver, that most relevant market, that needs to be removed from the legislation. I'm actually writing it down because I knew I'd forget. Article 4.1a in the MiFIR, it needs to be removed because that is the key, because we need that resilience. And when we had this outage before, and it's not picking on any exchange, I think when we had these discussions with those exchanges, they felt a little bit picked on, but we're not saying that. I have to say the market is extremely resilient and proved its worth, particularly during the pandemic. You know, that system really worked quite well, but we will have outages, and when we have them, we need to have a backup in place. We cannot have an outage where a market goes down for 3 hours and we lose the closing auction and then we can't trade. You know, that is not a good system. Again, treating our customers fairly and the best possible outcome. So we need, that will be the legislative change that we need, which I have to say is in this document, and so we're very supportive of.
Excellent. Stephen, you wanted to add?
I mean, I'd agree with the point that we're not picking on anyone for this. The market could not afford to pay for systems that never go down. To engineer them to that level, you'd either have to give up a lot of functionality or pay an absolute fortune. So systems will always go down. But when they do, the impact should be minimised. Yeah. We've got a system that should not have a single point of failure, but we behave as though it does. I think it's really important to realise that in some instances, when it's a primary market going down, they're not particularly incentivised to try and make the transition to alternative venues as seamless as possible, because they would profess to be the true former of price, the hub of the market. And as soon as another market is able to take over from them during one of their outages, that argument is diminished. So we've pushed for the market to try and come up with a resolution to this, but we are hoping that it will happen with the FCA looking at the process and weighing in if there is a reluctance on the part of any primary markets to support the development that's needed to make the market more resilient. I could say, read our response to the WMR. Maybe you've read it. It was the longest answer we sent in. It was many pages on the details of how this should look. But there are multiple parties in the marketplace trying to come up with a rational solution, and hopefully it's one that the marketplace can deliver for itself. Yeah. And if it can't, then you can help us.
I think that's the issue. Is I think there's a slightly defensive position being taken by some exchanges, which is wrong. That's the wrong way to think about it. You know, that we should be advocating for a more resilient, robust system that is better for everybody. So I think that's key.
If I may, Elisa, sorry, there's an interesting parallel here with the operational resilience rules that are being applied into the financial services industry more generally through the Treasury, the Bank of England, PRA and the FCA, where you have to identify your important business services and then have a commitment to be able to get your important business services back up and running. So just to keep back off, so maybe an outage at 10 o'clock in the morning, your period is until the end of the day, but it's, for you guys, it's more the auction, the closing auction, which is the really important thing, and maybe actually getting them to think around it in the terms of how the framework has been set out for the operational resilience rules may well be a suggestion for how they could approach it.
Yeah, that's probably a good point. I think the time of day is not so relevant. It's the messaging that went behind it and the duration, and nobody knew where they were. And then in the closing auction, nobody knew if their fills were good or not. So we had a really, really challenging situation, and it shouldn't be allowed.
Yeah, and there was a strong incentive to bring your market back up just as quickly as possible, which meant that in some cases it was brought up before it actually stabilised, and it was brought up into another mess and went down. Yeah. And there was a compounding problem. I mean, part of the AFME position is that if a system goes down, it should stay down for a minimum period of time. Yeah. Not come back within a minimum, but they should be forced to draw breath and make sure that they have got everything stable, and only then bring the market back up with due warning to the rest of the marketplace that it's coming back.
Yeah.
And in the meantime, clarity as to what's going on, to Richard's point.
Absolutely. Yeah.
Great. I'm conscious that we've been monopolising the conversation, and the audience might well have questions. So, over to you. Any questions for our panel? Please.
I assume there's no microphone. I was going to say...
I think there is a microphone, otherwise you won't be heard by those who are online.
Sorry about that. I was going to say, did anything surprise you between the publication of the initial Wholesale Markets review in the summer last year and this finalised version we're seeing back from the Treasury today? Were there any surprises between the initial consultation and what the Treasury is now taking forward?
Oh, I like this question.
I have to say no, don't I? I don't think so, because actually one of the things I will give the Treasury and the FCA and everybody a lot of credit for is the consultation process that they went through was incredibly, engaged with everybody. And I think actually they asked, what do we think? Why do we think it? All the way through the process. There were numerous individual meetings, numerous roundtables, numerous meetings with the various organisations and trade bodies. So not really. I think it's quite a positive. I haven't only glanced at it, to be fair, but what I've looked through, it looks quite positive and constructive.
Yeah. I don't think, if you can say pleasantly surprised, perhaps makes it better. I was very pleasantly surprised that the market's response to the original suggestion around mid-price trading had been taken on board so fully. And I think that's because I'm kind of used to a process where everything's a compromise. And if someone's taken a position, they don't want to reverse it and take the position of the other side, and they want to meet in the middle. So it was the first place I went to look, and I wonder if there's been some sort of fudge put in here around the quoting obligations, or not being able to trade mid in a size larger than your SI quotes. And the answer is no. So I was very pleasantly surprised that process of face saving isn't being repeated here. I think somewhat surprised that the consolidated tape is still being optimistically seen as something that will just emerge from the private sector without it being mandated. But time will tell. I think that perhaps the legislation that is pending to mandate the provision of data to the tape will cut through a lot of the commercial problems. As soon as it's, if you have to give me the data because I'm a consolidated tape provider, and guess what? I'm not going to pay you for it. So the commercial issues are addressed by forcing the venues to contribute the data. But no, there's nothing out of left field.
Good. Actually, I'm going to ask you a quick follow-up question. Do you think that there might be a problem with being obliged to provide data to any consolidated tape provider? Could we be in a situation where there's 5 of them who all want data?
Well, my bank would probably quite like to be one if every exchange has to supply me the data.
Free?
So, yes.
Yeah.
There's a problem with leaving the possibility of anyone becoming a CTP with the obligation that anyone who becomes one is sent the data. But I think that this leaves plenty of room to resolve that problem because there's an FCA consultation coming out about it, and that part of the being licensed as a CTP will presumably mean something along the lines that you're going to do it commercially and share the data with other people, and you're not just looking for it to either save market data costs or to get some sort of jump in competition in terms of direct feeds as a CT.
Definitely.
That's where the European proposals, I think, are a little bit more definitive on that front, because there was talk about there just being one per asset class coming out from whether it was an auction process. I can't quite remember exactly how the process was going to work, but they certainly seem to have committed to that and just have the one which...
It's a tricky one. So I have to say several of our peers, my peers, think that there should be one. So we are having follow-up discussions about that. And the reason for that is we completely agree that the whole point of the multiple is obviously competition and what that does, and it's a good thing. But how do we actually get to the point in the first place? I think that's the challenge. So if we have a competitive process that is one provider, then is that provider then therefore incentivised to really go after it, make it work? You have a tender process, etc. It feels like one initially might work, and then potentially it becomes multiple. But I think we're just a bit nervous. What if there is multiple? How do you choose which one? How do they actually get paid? How does the revenue work on that? It feels more challenging. Not sure.
Sorry.
Sorry, go on.
No, I would just want to come in on this, and I know this is a hot debate. And I'm not going to speak for the FCA, who is going to think, take this forward as we set out in the consultation response. But, you know, going back to the market outages discussion, you know, there was a clear example to me as in a place where if the regulatory environment is the right one, industry can step up and actually fill the void. And we think that was the position that we put together for the consultation. We think that in a market-led economy, a market-led solution to the problem is probably a good way, you know, a good place to start. That will be my contribution.
And as Stephen says, we'll discuss it a lot more with colleagues in the first row. But going back to the room, we have another 10 minutes. So if you have questions, now is the time. Over there.
Sticking with the consolidated tape point, there seems to be a shift in views as to whether a post-trade tape in equities would suffice or whether there's demand for pre-trade. And I'm just curious whether, I guess, any of the practitioners on the panel would like to opine on that.
I'm not sure if there's been a shift in view from the Treasury. The shift there has been that in the initial paper there was a prioritisation of fixed income over equities. Right. I think the market went back quite robustly and said, no, we should do both. And that's what's now being proposed, is that both should come forward. I'm not sure that the original paper opined on pre and post. I think it is... obviously, with European proposals to have only post with pre-trade data being looked at 5 years down the road, it's been a hot topic. I see very, very few people that think there's a big market for a post-trade only equity tape. All of the use cases, all of the reasons that you'd want to buy it are based on you having pre-trade data as well. You want both. That's how you understand the marketplace. I think it's quite interesting that not only did this come out today, but another note came out from FESI talking about MIFIR reviews, and its title, it talks about a consolidated tape and is suggesting that a 15-minute delay to the tape would be in the market's best interests. I don't quite see how it could be, but it speaks directly to the point that we started today with about this issue about dark trading being a healthy part or important part of a healthy market. That paper from FESI is entitled "Let There Be Light," and it witters on about the damage that dark pools are doing to price formation without any evidence, without any support from market practitioners, and quite the contrary, with both mathematicians and gut feel traders telling us that the price formation is very healthy. So I don't know if, that was your question, was about the pre-trade.
Yeah, I would probably say the same. I think I would definitely think that pre-trade, real-time, multi-asset is the way to go in the longer term. I think, to be brutally honest, there was an element of compromise. We were often asked the question, which would you prefer, what way would you go? And this was not just from HMT, it was from Europe as well. So in that instance, you almost had to give an answer, but at the same time we obviously emphasise that is what we want. It needs to be real time, because that obviously will lead to the success. I think, as you say, a 15-minute post trade, I don't really know, we wouldn't buy that. What relevance is that? It's not really useful or relevant in any way. So yeah, I think
I think that that point is spot on, and is perhaps caused some of the confusion, because the AFME response said that it should be pre and post trade data for the equity tape. However, if both can't be delivered in a relatively short period of time, start with the post trade and then go on and do the pre trade. But it went on to say, but you should never assume that there's any point in doing just the post trade. That any plans to phase it have to see as the near-term objective is having both. So I think there was some confusion from that, as you say, just by being forced to answer the question. But it's always been the position that I've been aware of on the sell side, that it should be pre and post trade.
Richard, chair's privilege. What's real time? Is it 1 second, 200 milliseconds?
That's a very good question. Well, I was actually just going to sort of lead further onto the sort of dark trading and let there be light comment from Feze, which, yeah, is a bit frustrating, because one of the points about dark trading or block trading, whatever you want to call it, is that these trades print in milliseconds after. So that trade is instantaneously seen by every participant in the market, and that post-trade transparency obviously helps the next pre-trade. Yeah, that is part of the process. So I don't know I don't know how I'm not clever enough to know whether it's milliseconds, microseconds, seconds, as soon as possible, as close to real time as you can possibly get. The reality is not many people, this is probably a wrong comment, but I'm not sure everybody needs it in milliseconds and microseconds. So I do think that if you can get it as close to real time, there's always going to be an element of latency. There's not much you can do about that. I don't know, it's hard, isn't it?
Consolidated tape is always going to get to the users slower than a direct feed from the exchange.
Yeah.
Just laws of physics, it's gone somewhere before it gets there. It's a longer journey, so it's going to take longer to traverse it. This debate about milliseconds, microseconds, it's arcane and kind of pointless. It should be as fast as technology and commerce will allow. I mean, you can't just say as fast as is possible, because then you've got to use microwaves to transmit it and come up with, or invent new ways of communicating the data. There's a cost concern to that as well. But as long as no one slows the data down deliberately, then it will be fast enough.
Yeah.
Not 15 minutes, that's for sure.
Yeah, or even 1 minute. Was it 2 minutes 59? People were slowing down reporting data when it was a 3-minute reporting rule. It shouldn't be allowed.
Yeah.
In the same way, there should be no throttle. There should be no ability for the contributors of the data, who again have vested interests in this not really working. They should not be able to sabotage it by slowing the data down on its way to the tape.
And some of those that have vested interests are selling ultra low latency feeds as well. Would just be one of my comments.
Claudia, you wanted to come in?
If I have to. No, I mean, I'm finding this debate incredibly interesting and fascinating, and I find it a clear... I do, I really do. And I find it interesting as well because it's a clear illustration of what I think, or what I've found to think about or conclude about the consolidated tape in the 1 year I've been in this job, which is that there are as many options as there are opinions. And that is a quite difficult place for a policymaker. What we set out today is that we acknowledge that there are quite a few options and that we want to take a flexible approach that will allow for some of these options, all of these options, a few to emerge.
Back to the audience. I think we can squeeze in one more question if the response is concise. Does anybody have one? Okay, there doesn't seem to be... sorry, Stephen,
you can't ask
you can see better than I can.
I'm joking. Go for it.
It's just looking through this document about the different ways that these changes are going to be delivered. There's primary legislation, there's FCA rules and guidelines, there's secondary legislation, but there's several where it says this will be delivered through the implementation of the future regulatory framework by the FCA. Mm-hmm. In what way, I don't know who I'm looking at here, but in what way is the FCA's delivery via the future framework different from them doing it through guidance at the moment? Are they going to gain more powers that they don't have just now? Or?
Do you want to have a go?
Well, the one thing that was coming through my mind so the latest consultation paper on the future regulatory framework had one of the planks of that was, I think, called designated acts or something along those lines, which effectively allowed the FCA to take what is onshored legislation into their rule books, effectively to then, in the future, give them more flexibility to change rules as opposed to having to make legislative change. Mm-hmm. So that might be one thing that's getting at. Having not looked at this and thought about it in any depth, I will defer to others who might have another view. I don't know, Claudia, if you
I'm happy to pick up from this point onwards. So we have consulted on the future regulatory framework review, and I think the consultation closed recently. And where we propose there, I think you touched on one, it's to delegate and transfer all the firm-facing requirements that currently sit in EU retained law, which is the statutes of primary legislation in the UK, to the expert regulators. And that will be a programme of secondary legislation that affects that transfer. And when that's done, the regulators will have the flexibility to enact those changes in their rule books and make those the changes that we're considering through the Wholesale Markets review in their rule books. That's one part of your question. The second part of your question related to the FCA powers. We recognise that there might be gaps in the powers that they have at the moment, and where those gaps are identified, that will be another objective for the FRF. We will plug them.
Thank you, Claudia. Without scripting, we got to a very natural end and an excellent segue into the next part of the conference, which is the FCA telling us what they think about what happens next. But before we get there, I know I speak for everybody for thanking our panel for making what could be quite a dry subject really interesting and showing the real-life implications of the choices that are being made. So thank you.
Thank you.
For their ability to ask themselves questions as well as answer them. That was fantastic. We'll just give them a few microseconds to clear the stage without the use of microphones or microwaves, and we'll invite up for our closing discussion together with Edwin Schooling Latter from the FCA, AFSCME's Jacqueline Mills. Jacqueline, thank you.
Thank you, Peter, and good afternoon, everybody. Nice to see that you're all still here. I have the pleasure of introducing Edwin Schooling Latter, who I'm sure most of you know. Edwin is Director of Markets and Wholesale Policy at the FCA. He's responsible for the FCA's policy development across a huge portfolio, so that's primary markets, secondary markets, benchmarks, market abuse, commodity derivatives, asset management, pensions and funds, so only that. Edwin will be talking to us today about the FCA's work program now, specifically with respect to the wholesale market review. And indeed, we had a brilliant segue in terms of the FCA's powers and roles and responsibilities and what the FRF will be conveying to the FCA. So we'll pick that up in the discussion afterwards. Edwin, please, the floor is yours. Thank you.
Thank you very much, Jacqueline. It's a great pleasure to be with you all this afternoon, to be amidst and among the best of Europe. As we meet today, of course, the normal business of financial markets is overshadowed by the terrible events in Ukraine. And our immediate priorities in the FCA are assisting government and working hand in hand with our partner authorities in the EU, the US, Asia and elsewhere in responding to that crisis. The issues we're discussing today are part of more medium-term work streams, but it remains important to ensure that the UK's wholesale financial markets are as fair as effective as they can be. And there is an opportunity for all in this room in the period ahead to be part of shaping those financial markets for the future. Now, from our past membership of the European Union, the UK inherited a framework with which your businesses are familiar because it's applied not just here, but across 30 other countries. And we understand and appreciate that if you are a business active in multiple jurisdictions, as many of you are, there is a benefit and often a cost saving in rules that are the same or similar across those jurisdictions. Indeed, that logic applies more widely than just in the EU. And that's why the UK authorities have worked so hard over past decades to have common international standards. We now have an opportunity to build on that strong platform that we've inherited and to optimise it for UK and the UK's international market participants, while avoiding unnecessary change. Now, you'll be aware, you've seen today, that we and HMT colleagues have been working together very closely and with you to do just that in both the primary market and the secondary market spheres. And the relative simplicity of the UK's institutional setup for financial market rulemaking to be further streamlined as part of the future regulatory framework, when parliamentary time allows, means that we have a structure in which, where there is consensus, we can move quickly. Now, I'm actually going to start with primary markets, which have been discussed less today. And I think the background to that is that the UK's primary markets proved that they work well during the COVID-19 pandemic. They enabled issuers to raise capital quickly to address the disruption the pandemic caused to their businesses. And to add some more numbers to those that the Minister used earlier, UK markets raised £24 billion in new capital in the first half of 2020 alone, through 327 separate transactions. Now, that's more than 3 times the next busiest European market in both volume and number of transactions. But Lord Hill's listing review, published in March 2021, helped illuminate and shape consensus on a number of refinements to our regime. And the FCA has moved at pace to address Lord Hill's findings. Published in March 2021. By the end of April 2021, we'd published a consultation paper on changes to our listing rules for special purpose acquisition companies, SPACs. By late July, we'd confirmed those changes following support in consultation. They took effect on the 10th of August 2021. The changes mean that SPACs that comply with higher levels of investor protection are not subject to a presumption of a trading suspension at the point a target is identified. Our model was designed with the specific intention not to invite a rush of poor propositions. But we are pleased that we now have had examples of SPACs who've listed in the past months structured to take advantage of that approach, and we have others interested in doing so. In July last year, we published further proposals to adopt rules on 1, a targeted form of dual-class share structures within our premium listing regime, 2, increasing the minimum market capitalisation threshold for premium and standard listing segments from the old £700,000 level. We ultimately raised it to £30 million. 3, reducing the required free float level from 25% to 10%. And 4, allowing more waivers to the 3-year track record requirement for issues. After confirming support for all of those through consultation, we'd published our rule changes by the end of last year. And I say all that to show and evidence how quickly we can act with the framework that we have. We haven't finished. We will be publishing later in this half of this year a discussion paper on other ways we might reform the listing regime to establish a model that is more effective for both issuers and investors. We're now working with Treasury on Lord Hill's recommendation to recalibrate the prospectus regime to make disclosures for different types of capital raising more proportionate to the type of capital raising being undertaken. Now, this is to some degree a return to previous UK practice, and it reflects a market consensus that applying the same uniform regime to, on the one hand, admissions to trading on regulated markets and secondary capital market raisings on those markets, and on the other hand, to public offers of securities, is a one-size-fits-all straitjacket that fits no one very well. Now, implementing reforms that achieve that outcome will require changes to UK legislation. You guessed it, when parliamentary time allows. Now, Treasury first consulted on all this last year. We've seen a response today. The aim is both to improve the efficiency of public capital raising and to improve the quality of information that investors receive. and moving the detailed rulemaking power over prospectuses from primary legislation to the FCA in the same way as other detailed rule-making responsibilities will be delegated to the FCA as part of the future regulatory framework, will enable us to adapt those rules in a dynamic way as and when the market needs. And I should also note that Mark Austin's review into secondary capital raising is also shortly to report, and we look forward to engaging with its findings. Let me turn next to secondary markets, which you've been discussing. As you know, further to Treasury's Wholesale Markets review, the ministers confirmed the government's intention to repeal the double volume cap and the share trading obligation, to recalibrate the transparency regime for derivatives and bonds, and to reduce the scope of the commodity derivatives position limits regime. The Minister described to you earlier today how some of the changes will be taken forward. And the FCA set out in our 2021-22 business plan how we are committed to progress consultations on parts of the UK's MiFID regime that fall within our rules and our guidance, but relate to that wholesale markets review. The EU is also currently reviewing MiFID. We're not interested in divergence for the sake of it. Our objectives for market functioning, fair pricing for investors, the safeguarding of market integrity, competition in the interests of market users, are in substance the same as those of our EU colleagues. We're searching for, and I'm sure will achieve, the same outcomes. Indeed, you saw during the pandemic that both we and the EU made a number of the same changes. For example, suspension of the RTS 27 best execution reporting requirements that provided little value given the cost and effort of producing them, and changes we each made to short-selling reporting thresholds. We know that change itself can incur costs. Differences between regimes can have a cost for international businesses. But where we can achieve better outcomes for you or your customers from change, because change improves market integrity, helps protect customers, or indeed reduces cost, we will take forward that change. The government here has always been clear that this is not about making change for change's sake. Where there is change, it will be to make doing business better for all involved in that business, for international firms and domestic ones, whilst maintaining high standards of regulation. And we agree in the FCA very much with that approach. There are some places where the details of our approach differs from the regime we inherited from the EU. For example, while we in the UK are removing so-called dark trading caps, the EU is moving to tighter restrictions on this so-called dark trading. As the panel noted, in the UK, we have in effect experimented with removal of the dark trading cap for the past 12, 13 months. It's made little difference. And after a modest uptick when we suspended the DVC, the level of dark trading has not in fact changed materially. In the final 6 months that the DVC regime in the UK was in force, when caps were in force, dark trading hovered between 12% and 15% of total on-volume trading. Obviously a much smaller amount of total trading, including SIs and so on. And that includes blocks. Since we suspended the DVC, it has varied between 13% and 16%. Now, like our EU partners, we attach great value to effective price formation. We want to retain the transparency that is necessary to support it. Lit markets do have a key role in that. But on the back of that experiment last year, it's hard to justify the hassle and cost of running a dark trading cap regime. Indeed, our research showed that market participants doing a proportion of their trading on venues with lower levels of pre-trade transparency, including in periodic auctions, achieved lower transaction costs. We found that neither bans on dark pool trading when caps were hit, nor the removal of those caps significantly affected the transaction costs of investors in UK equity markets. Now, we will continue to monitor the data. We're always open to new evidence. We'll be very pleased to discuss it with market participants from all sides. But evidence to date has not supported an argument that dark trading caps lead to better investor outcomes. There are other areas where our roundtables with market participants and responses to the Wholesale Markets Review consultation suggest consensus for change. For example, the trade reporting obligation, currently determined by whether a counterparty is a systematic internaliser on an instrument-by-instrument basis. Elisa, Stephen, you'll be pleased to hear that we will seek market views on allowing firms to elect to be reporters, regardless of whether they are an SI in a particular instrument. Now, market participants have also asked if the FCA could maintain a list or a golden source of such reporters, giving clarity to market participants. And we are open to considering that idea if it would help market participants. Currently, UK trading venues can use reference prices derived from EU venues under waivers granted prior to Brexit. That has been working well. So we think there is a case for allowing UK trading venues to source reference prices from any overseas trading venue, providing those prices are robust, transparent, and consistent with best execution. New waivers could be granted allowing prices derived not only from EU venues, but also venues in other jurisdictions, such as the United States or Switzerland. Now, closely related to that, the MiFID tick size regime does not work well for shares that have their main pool of liquidity outside the UK. So we will consult on changes to allow the use of tick sizes from an overseas primary market when these are smaller than those that would be determined based on UK trading. For newly issued instruments, we will seek views on proposing to allow the UK venues of the original listing to set the initial tick size. This could reduce the cost of trading for buyers and sellers of shares. And these changes gathered broad support from respondents to the Wholesale Markets Review consultation. Respondents to that consultation also flagged that it's difficult to interpret trading data in a way that reliably identifies addressable liquidity, i.e. liquidity that those who want to buy or sell a financial instrument can actually interact with. We would like to seek market views on changes to improve post-trade flags. So that's the descriptors required in post-trade reports to identify the nature of the trade. In doing so, we could leverage already widely used industry standards, such as the typology developed by Fixed Trading. We've also heard the complaints about the costs of trading data and the terms on which they're made available. In the months ahead, we will be analysing closely the prices, costs, the licensing requirements for trading data to see if they are consistent with competition in the interests of market users. We want the UK to be a good place to do business, both for the users of trading data and for trading venues that generate such data. Another area of MiFID which has introduced significant complexity into wholesale markets is the regime for calculation of thresholds for block trades in bonds and derivatives. Now, that is, of course, the size threshold over which large orders can benefit from waivers from pre-trade transparency, or large transactions can benefit from deferrals from post-trade transparency. The Minister mentioned, I think, 1,000 pages of MiFID regulation. Well, there are 145 pages of technical standards just on how the pre-trade and post-trade regime operates. Now, in most cases, no obvious harm has arisen from the calibration of the large in scale thresholds in MiFID, in our view, aside from the costs of the calculation and the application process. Although there was a notable calibration issue in respect of commodity derivatives, for which exchanges here had to build some complex solutions. Now, in our view, we can probably reduce complexity by returning to the trading venues the responsibility for setting LIS thresholds for exchange-traded derivatives. And we'll consult on doing so. We'd like to explore if there's scope for other simplification, especially if that simplification can be accompanied by harmonisation or reduction of post-trade price transparency deferrals. So perhaps allowing more delay to disclosure of size of transaction than is allowed to disclosure of price. And by doing that, we would hope to take out some cost and complexity while improving transparency. So our plan is to consult from the second quarter of this year on the detail of some of those changes I've described. As always, we will greatly value market input on our proposals to help us get them right. Now, we can act first where rules are set out in technical standards and are not dependent on parliamentary time. For example, we may start with tick sizes and the trade reporting regime, so some of those elements I described in respect of equities. Under that future regulatory framework, also consulted on, most MiFID requirements will, at some point in the future, subject to parliamentary decision, move to the FCA handbook. And that will allow this more dynamic and rapid adjustment of these rules if they're not working in a way that benefits markets. But I've talked a lot about rules, and my final remark is that regulation is about more than rules. In our business plan last year, published last year, we explained our focus on being an innovative, adaptive, and when necessary, assertive regulator, on being outcomes focused and being data led. We said that we will partner effectively with others, that's you, to achieve our aims. Now, for example, over the past few months, the UK financial industry, working hand in hand with the FCA and the Bank of England, has been completing a transition away from sterling LIBOR and new use of US dollar LIBOR. Now, with close to $300 trillion in exposures to LIBOR across derivatives, bonds, securitizations, corporate loans, mortgages, and more, many described that as a change as big as MiFID II. But the deadlines didn't slip. Together, we did create new markets that have prospered. Risks to financial stability that we worked hard to identify and manage did not materialise. Conduct risks have not materialised. This is an example of what can be achieved by the sort of regulatory and private sector cooperation that we have here in the UK. And it's now time to do more of the same in shaping our wholesale financial markets. And I look forward to working with you to make the UK's financial markets the best in the world. If I could me. Is that too close? COVID sort of restrictions are over.
We're replicating what the Minister and Adam did earlier on.
Great minds.
Edwin, thank you very much for that. You gave us a lot of very interesting detail. Can I ask you to sort of further contextualize for us with respect to your work program, what the FRF will give to you, when it gives it to you, where you need new powers, where you already have them. I mean, I could sort of, you spoke about sort of where things are in the EU equivalent of RTSs, you can already act. But could you sort of try and give us maybe a 6-month timeline? Another way of asking the question could be, when will the regulatory grid be updated? Because that's a fantastic tool for us to understand what's happening when.
To firstly thank you for the advertisement for the regulatory grid. If no one's seen that before, we and the other regulators in the UK publish a pretty comprehensive forward look of what's coming. We sometimes call that helping with air traffic control, so that you can see all the different planes and how they might interact with each other. On the Future Regulatory Framework, or FRF, apologies for yet another acronym to complicate your lives. I think the really important piece of that future reform to have in your minds is this, that at the moment the UK's financial market framework, like the EU's, is spread across what in EU speak is level 1, so primary legislation, which only Parliament can change. This level 2 technical standards, which of course the FCA can change, although we do consult with the Treasury when we do so, and then guidance and other rules that sit in our handbooks. Now, bits of that we can change even when parliamentary time doesn't allow, and those are the things that we can get on with first. So when I mentioned a Q2 consultation paper, that's going to focus on the things that we know we can do because they're in our rules or in the technical standards. And I gave some examples of what we did last year on the primary market side within 9 months, because there was consensus to do it and get it done. So things like free float rules that are in our rules rather than parliamentary legislation.
Thanks very much for that. I guess we still don't know when parliamentary time will allow, but we'll be looking out for it. I also wanted to ask you if there's any areas or any reasons why your temporary transitional powers would perhaps need to be extended. If you see a risk of any gap, we've discussed some of them today, I think, with respect to the shared trading obligation, derivatives trading obligation. Any risk of there being a little gap before parliamentary time does allow for changes to be made?
Yeah, so the temporary transitional powers, TTP powers, ordinarily expire at the end of March this year. I know at one point in the past there was some concern that would mean that the actions we'd taken to prevent unintended consequences from the derivatives trading obligation applying on a sort of national rather than a pan-EU level might have to be undone at the end of March. I think you all know that that's not the case. I think you heard earlier that in fact those measures, DTO, STO, will apply until the end of this year. So you've also heard, I know you put Claudia on the spot on this question earlier, but I think what is clear is you know the direction that we are heading, you know what we want to achieve, you know when we need to achieve it by. You will have to leave it to us and the Treasury and parliamentary time to work out the precise mechanism for that, but I think the direction and the timing are clear.
Okay, thank you. That's very reassuring. Thank you very much for that. You mentioned that you mentioned the EU's MiFIR review, and obviously you're keeping an eye on it. Any steps that the EU is taking which you find inspirational, which you think could be sort of integrated into the UK framework? Or on the contrary, any sort of concerns or issues that you see? coming from the EU?
So it's a good question. We were in the EU a long time. I sat around the ESMA board table, as I mentioned in my prepared remarks. The objectives that we have as a financial regulator are essentially the same as those that our EU partners have. So I think not surprised, and we've been living with the same regime and seeing some of the same outcomes. So I don't think it's surprising that there are some areas where actually we probably feel pretty similarly about what the next steps in change might be. And there are elements of that EU MiFID review that you can see reflected in the discussion we've had here today. So for example, improving access to market data, the potential reforms to the post-trade deferrals regime in fixed income, so simplifying that, which is obviously very complex at the moment. Another area of commonality. I think we both would agree actually that on the derivatives trading obligation there are some circumstances in which some flexibility to vary that to avoid unintended market outcomes at times of stress and so on is also a good thing to have. So lots of commonality. Yes, one or two areas of difference as well, and we talked about one and the so-called dark pools, although yes, crossing networks might be a less pejorative term to use for those.
Thanks for that. Do you see a difference though, sort of going forward? I mean, I think there is one major difference is that the calibration of these aspects of the rules will, if I understand correctly, be within your powers. Whereas in the EU, a lot of this will still be left on the statute book, so at level 1. Does that make a difference?
So I think that does mean, as I mentioned, that if we do want to change things, it will be possible to do it here probably more quickly than is easily done within the EU. Now, I mean, having said that, there are obviously times when the EU can and has make its process work very quickly, but it's going to be relatively simple here compared with on the continent.
And then a question which has already been asked earlier today, and I think you touched upon it in your remarks as well, but there'll be differences in nuance, emphasis, of course. It's different markets. You need to cater for the size of and specificities of the UK markets when developing your rules. There'll be difference, and now we've spoken a little bit about the pace of change as well. Yeah. Given that a lot of the market participants and AFME members are global firms acting across several markets, do they need to be concerned about the costs of another regime to manage in parallel?
So I don't think that market participants that have businesses both in the UK and in the EU do need to be excessively worried about this, because I can assure you all that we're super conscious of the costs from unnecessary change. And I mean, as well as the kind of formal requirement that cost-benefit analysis is an absolutely integral part of any change proposals that we make, I think you can be reassured that we're just aware of that. So if I say our objective is that here is a good place to do business, we will not serve that objective well if the calibrations we make cause cost and inconvenience to really important international firms rather than benefits. Conversely, there are going to be places where calibrating for our market participants, including you, and having a little bit of difference because of that, is manifestly in the benefit of market participants here, in which case I think we'll want to proceed with those changes. But the other flavour I hope you get from some of the detail that I've given is that many of the things at the top of our list are actually quite permissive changes that take away complicated requirements and processes and allow market participants more freedom to do what they would like to do to achieve best execution. And I think in principle those types of changes generally don't generate additional costs.
Thanks, Edwin. Perhaps this can be my last question then. And I think you've started giving, again, elements of the response, but the FRF, we expect, will give you a secondary objective with respect to international competitiveness.
Yeah.
Can you talk to us, in addition to what you've already said, about how you would go about achieving that in practice?
Yeah. So, I actually got asked this question in the Treasury Select Committee last Monday, so it's very much at the front of my mind. Now, the first thing I'd say is that the FCA's existing statutory objective is about making financial markets work well. And I actually think that's not a million miles away from some elements of competitiveness, in the sense that if we make markets here work well, people will want to be participants in them. At the same time, what I said to the committee is that having a formalised secondary objective around competitiveness or sustainable growth, and it does need to be sustainable and over the cycle, is actually quite empowering for me and my teams, because in a very literal way, if we had a change we wanted to make that had no direct benefit for sort of consumer protection or market integrity, but just removed cost that achieved nothing from the system, under the current regime we wouldn't actually be able to do that, because Fabio has to fill in the piece of governance machinery that points out which of our statutory objectives it advances. And if it only advances one that makes us more competitive, well then doesn't pass the necessary tests. So I welcome that. But what I also said, along with Bank of England colleagues, is that if that were a primary competitiveness objective, then there would be very direct trade-offs with our other objectives around consumer protection and market integrity. And we all gave some obvious examples of that. So, for example, if firms hold less capital, that makes it cheaper for them to operate. But it also makes it more likely that things will go wrong, or that they, in a consumer sense, they won't be able to pay redress when things go wrong. So that, I think, has very important consequences that, of course, Parliament and government would want to consider very carefully. Ultimately, as a regulator, we are here to serve the will of Parliament. So whatever our objectives are, we will do our utmost to achieve them. And I think you saw from Fabio's comments earlier that that statutory objective, our three operational objectives in statute, are kind of written through us like they are in a stick of rock. And if new ones are added, then we will treat them in the same way and make sure we advance them.
Thank you very much, Edwin. I could carry on asking you questions all afternoon, but I won't. Thanks very much for being with us today. And we look forward, as AFME and as the industry, to engaging with you over the coming months and indeed years as the framework progresses. Thank you very much.
Thank you.
Well, thank you very much. And our conference is drawing to a close, and I think you'll all agree we've learned a lot. We've learned that the Treasury is supportive of the wholesale markets here in the city, to the extent of sending the Minister here on foot to tell us all about it, and that their reforms will follow when parliamentary time allows. We've learned that there are some very quick readers operating in our wholesale markets. I think the latency between the publication of a consultation document and a dissection of it expertly on a panel is measured in microseconds, so that was pretty good. We've learned also that the FCA are looking forward to regulatory and private sector cooperation, and that they're committed to do that through their new committees engaging with market participants, which I think is a great innovation to learn about. And I guess we've also learned that dark pools need better PR. And rather surprisingly, that rebranding is being led by the Treasury and the FCA, who are only too keen to remind us of that fact. So it's been quite an education. I hope you'll look forward to reading the remainder of the materials that came from the Treasury today and the FCA papers that will follow in due course. We at Linklaters, as always, will be dissecting this stuff and communicating our own thoughts on it with the market as quickly as we can too. But I'd like to thank once more all of our panelists and keynote speakers and interviewers today, who I'm sure you'll agree have all done a fantastic job. And so thank you very much to all of them.